So good morning and welcome to this conference on the post-COVID inflation episode in emerging markets. Welcome to Brookings. I'm Gian Maria Milesi Ferretti. I'm a senior fellow here at Brookings at the Hutchins Center on Fiscal and Monetary Policy. And I'll just literally take a couple of minutes of your time just to say where this conference was conceived or why. We thought about it because the debate on the post-COVID inflation episode is very often limited to or just focused on the case of the United States, which is, of course, very interesting and very consequential for what happens in the rest of the world. But at the same time, it is also very limited to look just at one country, given that there was clearly a big global dimension in the inflation episode. The pickup in inflation was really widespread across countries. And we thought emerging markets are particularly interesting for a variety of reasons. The first one is actually why emerging markets, given that the policy support that most emerging markets were able to provide, in particular with fiscal policy, was more limited than the policy support in advanced economies. So it was harder to think of generalized excess demand pressures materializing in countries where the push to aggregate demand had been less strong than the one we saw in many advanced economies. So thinking of the triggers of the episode, one factor that pushes towards thinking of inflation in emerging markets becoming more of a problem is the importance of food and energy in emerging markets' inflation baskets. So clearly, the global increase in energy prices and food prices was central to the inflation shock. And in emerging economies, typically these goods account for a larger fraction of CPI, and hence mechanically you would get a bigger inflation shock. So you had two countervailing forces in a sense here. A third aspect, which is of particular interest, is the policy response, which was way swifter in many emerging economies. Some started raising rates in the first half of 2021, well ahead of advanced economies. A fourth aspect was how differentiated the increase in inflation was. Inflation rose everywhere, but it was clearly a different story in emerging Europe and in Latin America vis-à-vis emerging Asia, where the initial rise in inflation was more modest. In 2022, we had an additional regional shock, which was the increase in gas prices in Europe, which had dramatic implications for the cost of gas and electricity in Europe. I don't refer to, I say limited to Europe, because surely there was also an increase in oil prices, but that is generalized across countries, the increase in gas prices, gas being less traded than other commodities, given the difficulty in shipping it, was very concentrated in Europe. So we thought that just these 4 points were more than sufficient to generate interest for a wide-ranging debate or a deeper look into what happened over the past 3 years. This is why we asked Antonio, Fatás, Refet, Gürkaynak, and Juan Pablo Medina to write a piece on emerging Asia, on emerging Europe, and Latin America. And we're going to start with Antonio, who is going to tell us why emerging Asia was less burned by the inflation episode than other parts of Europe. Thank you.
Can I just mention one housekeeping thing? So this is on the record. It's being live streamed. So moderate your comments accordingly.
for inviting me to be part of this conversation. As Maria said, I think we've talked too much about the U.S. inflation with our understanding how the rest of the world looks like. Now, I was trying to figure out why emerging Asia was different. That's the focus of my presentation, the different part. Why is it different from others? Now, a couple of things just to get us started. First, different compared to whom? Now, I'm going to do a little bit of everything, compared to advanced economies, compared to other emerging markets, compared to similar episodes in Asia in the past, because I think all these things are relevant when we think about different to whom. And then a few things that I had to deal with, and I'm going to tell you in advance. Of course, when I talk about Asia, I'm going to generalize. There's a few countries that behave very differently, but I think there's a pattern. I'll talk a little bit about differences, but very fast. Every time I show you averages, because not always I can show you all the countries, you're going to be thinking this is dominated by a couple of large economies, and the answer is yes. China matters a lot in the averages. At the same time, you'll see when I separate countries that while China is unique, it's not that unique. There's a lot of similarities between what happens in China and the rest. Whenever it's relevant, I'll get rid of China and show you an average without China. Sometimes I will not because it doesn't make any difference. Now, the issue of data is always an issue when you try to look at many emerging markets and low-income countries. Sometimes there's no data on certain variables. So my samples will not always be the same, so be careful. Always check how many countries I have in a sample. I've done my best to try to compare similar samples if I ever thought that was an issue, but there's going to be an uneven coverage. And some might be thinking we're presenting these papers too early because the inflation episode maybe is not over, maybe some interesting things are about to happen. Again, we can only speculate on that going forward. Now, let me just say something really fast about before 2019, how did we think about inflation in Asia and other countries? Again, lots of papers written. This is not a comprehensive literature review for sure. We used to think that inflation was dominated by global factors, increasingly so over time. So we used to think about global shocks. Of course, many of us were thinking about the Phillips curve and any other similar frameworks to think about inflation, both in advanced economies and in emerging markets. We used to have the view that inflation targeting was good to reduce inflation, but also to reduce the persistence of inflation. And then we lived in an environment where in advanced economies, we were struggling, in some cases, with below target inflation. That was our concern. And in emerging markets, in particular in Asia, we had seen a really significant structural decline in inflation over the last 2 decades. And if you look at some of the most recent years, maybe not the last 5, but the last 10, we had seen a little bit of what I would call an opportunistic disinflation. As commodity prices had come down, some of the Asian economies had seen a significant decrease in inflation. So you see a nice trend coming into 2019. Now, it all, of course, fell apart in 2020. Like everywhere else, inflation increased. Now, some very broad statements that I'm going to back by data in a second. Inflation increased by a large amount in advanced economies. Not so much in emerging markets. In fact, I would say most of these emerging markets, I would say the increase is not that unusual compared to previous episodes. Now, Asia is, to me, a little bit of an outlier because not only the level of inflation was lower, but also the increase was lower. Now, let me show you a few slides. I'm going to try to show the slides that are more meaningful. This is a way to compare advanced economies to emerging markets before I say anything about Asia. On the left-hand side, you see advanced economies whose inflation was high. Now, I'm using 5% as an arbitrary number. On the right-hand side, emerging markets where inflation was high. I'm using 10% as an arbitrary number. And this is counting countries. I could also do a share. Now, you can see in advanced economies, this looks a lot more impressive, the last spike. While in emerging markets, you see a spike. It is smaller than in 2009. Again, there's other ways to show you the same outcome, thinking about average inflation. There is a spike, but it's not that unusual compared to other episodes in emerging markets. Now, what if we look at Asia in particular? If you look at the left-hand side, you see in green Asia. You can see this is headline inflation. I'm starting in the year 2000, so just looking at more recent data. You can see a spike around 2021, but that spike is quite limited. And if I didn't have the other lines, it would be hard to say there was something really special in 2021. It's just a cycle, like some of the others, in fact, more moderate than some of the others. Now, if I bring all the emerging market groups, which I do on the right-hand side, Now, the spikes there, which have to do with outliers in other regions, not Asia, so I'm not going to talk about them. In Europe, you have, according to the IMF classification, you put Turkey and Russia. So you see spikes there, which are driven by large countries with very high inflation. Now, the line which is Asia, in this case, I'm going to exclude China, just so that you're not thinking this is all about China. You do see a little bit of a spike at the end, but again, it's quite limited and similar to previous spikes that we've seen in other cycles. Now, what about if you start looking at individual countries, just in case the average is hiding a lot of things? On the left-hand side, a few large emerging markets. Apologies, that is hard to put all these colors in a way that is easy to see. China, no inflation at all during this episode. India is in yellow. There is a spike of inflation, but once again, similar or lower than in previous episodes. Much bigger spikes if you are sitting in Brazil, if you're sitting in Mexico, of course, if you're sitting in Nigeria, or if you're sitting in Poland. So these are a few large emerging markets. You see the same pattern across regions. Now, a little bit of sort of diversity on the right-hand side. So this is all the Asian economies, emerging market Asia. Each line is one country, and the average is dark. There is some variation towards the end. You see two spikes. Those are Sri Lanka and Laos. So yes, if you want to find high inflation in Asia, you will find it, but it's a little bit the exception, not the rule. And again, the average is the same as before. It's quite flat. Now, here comes a question that Gian Maria mentioned in his introduction. In many of these countries, food price and energy prices are very important. So how did Asia behave in these two sectors? Again, they're very important mechanically. They're a high percentage of the CPI. Again, you see the same pattern as in the headline inflation. Both in food price and energy price, Asia has the lowest inflation rate, and it has the lowest jump. Again, it depends how you present the data. Sometimes it's hard to see. On the right-hand side, when you compare to Europe, of course, the scale becomes very large. But if you just look at both green lines on both charts, you see lines which are very flat in both cases. So again, once again, it just the same message comes through all these slides. Asia is a little bit of an outlier here. Inflation did increase, but inflation did not increase that much compared to other countries, that much compared to other similar episodes. Now, that was just to give you an overview of how I see Asia. Now the question is why? A lot of what we're going to try to figure out today, why was it different? Now here I'm going to take what I'm going to call the accepted framework that we all have today, again, with some questions about what led to the pandemic inflation or the post-pandemic inflation. Now, my discussant has a paper that was presented here a couple of years ago, what happened in the US. There's tons of papers that have been written about this. Now, this is the way I read the consensus. First, the global component in this episode is really large. In fact, the book, the CPR book that just came out and was presented here at the Peterson Institute on Friday, says it's even bigger. That global component is even bigger than in previous episodes. We all agree that supply shocks, whether it's supply chain shortages or Ukraine, matter a lot to all countries. So I'm going to start with that assumption. And then we all understand that cyclical conditions were not the same everywhere. So we had a lot of conversations about labor market tightness in the US, and of course about policies. And here I'm going to explore both policies, fiscal and monetary. When it comes to fiscal, I'll say something about conventional fiscal policy. By that I mean just aggregate demand stimulus. Unconventional, by that I mean price subsidies, trade restrictions. And then I'll have to say something about monetary policy. I'll talk about the interest rate response. Was it different across countries? Does it fit the data? And what about something which is much harder to measure, but I'll try to do something about it? What about credibility and anchoring of expectations? Did that matter? Now, let me start with the cyclical conditions. Now, typically, if you're doing a paper on the US, you'll run a Phillips curve with unemployment, and things will work quite nicely. Unfortunately, if you try to do the same thing for other countries, which I will, it is harder. And it's harder because unemployment does not look like US unemployment everywhere. It even looks less during the current cycle. So first, this is a view of the data just to get a sense of what it looks like. Unemployment did increase in the pandemic, during the pandemic, but it increased in ways which is sometimes a little bit noisy, spike in Asia, spike in Latin America. You don't see much in emerging Europe. Now, you don't see much in advanced Europe either because of policies to keep unemployment constant. but again, that's a little bit hiding the lack of activity in those months or quarters. You see a little bit, very little, is sub-Saharan Africa. So here what you see is first, there's a lot of behavior of unemployment which does not look like the US in any cycle. In this cycle was even more different. Now, if I cannot use unemployment, what can I use? Something that is based more on activity, GDP, production. But then you need a measure of slack, and that is hard because we need to construct a measure of the output gap, which is not easy. I'm going to do it anyway. So this is what I've done to construct this indicator. Now, I'm going to take an approach which is, let's just look at one cycle. One cycle, I mean, I'm going to start in 2010, post the global financial crisis. We have an expansion which is quite stable in the world. In fact, if you look at growth rates around the world, they're the most stable they've ever been in any expansion. So you take that as the trend. Whatever happened between 2010, 2019, you extrapolate that trend, and then you look at deviations from that trend post-2020. Now, I know it's not perfect, but it gives us an indication of what growth rates look like compared to the previous expansion growth rates. Now, I have all the emergings, Asia without China, and a couple of other regions. Now, what do you see? 2020, very similar across the board. So very similar, large negative numbers. But then if you look at Asia, or Asia excluding China, which is the orange and the gray, they remain quite low for 2021, 2022, even 2023. Which means, you can remember how I built this, growth rates in Asia did come back to normal, but they never overshoot normal, so you never close the gap that you had opened during the crisis. Is this truly slack? Maybe. It could also be that was a structural break in growth rates. That's possible. Now, I don't have an explanation of why that would happen in Asia and not anywhere else. Now, my argument is, even if there's a little bit of that, and the structural break in growth rates, one could argue that it could affect inflation as well. Again, it depends a little bit what we mean by structural. So I take this as a view that demand conditions were weaker in Asia than in other countries. That goes a little bit in the direction of explaining lower inflation. Now, I've done similar output gaps using quarterly data. I didn't say it, but the previous chart with annual data, because there's no GDP for many countries quarterly. Now, you're not going to see colors here, but I can guarantee you the last three lines are the three Asian economies if you use quarterly data. So India, Indonesia, and the Philippines had a larger output gap than any of the Latin American countries there, or Poland, or South Africa. So same message comes through. Now, is this truly an output gap? Do we know why this happened? And I think we have a partial answer of why this happened. If you look at the reopening from COVID restrictions, was not the same in every region. Now, as someone who was living in Asia during those years, I can guarantee that they were not the same. If you do a quick analysis of one of these stringency indices of COVID restrictions, what I've done here is taken an average from the countries in the previous chart, just to match the same countries. So Asia means the three countries that were in the previous chart, Latin America, the four countries that were there. Now, the Asia line is the one that is on top of everyone, in particular in 2021 and 2022. So 2020, of course, was very similar across the globe, but then the reopening was much slower, which sort of coincides with the timing of the output gap that you see in my previous slides. So again, even if it's hard to measure the output gap, I do think the combination of what you see here on the previous two charts, I think they signal that the demand was weaker in Asia than in other countries. So let me try to put this into some quantitative framework. Can this explain some of the difference in inflation in Asia? How much? Here I'm going to run some Phillips curve type regressions. I'm going to start with unemployment, even if I don't have a lot of faith that this is going to work, and it's not going to work the way I think it should. Only look at the boxes in red. So across all columns, unemployment comes with the right sign. This is data from 2000 all the way to the end of 2023, quarterly data, fixed effects, time effects everywhere. So the first line makes sense. Unemployment comes with a negative sign. Now, I want you to focus to the box on the right-hand side. What I do there is the following. In column 4, I have dummies for all the EMD regions post-2020. So I'm trying to understand how different was inflation in these regions relative to what? Relative to advance. So advance is by benchmark in this regression. So if you focus on Asia, minus 2.4 says inflation in Asia was 2.4 percentage points lower than in advance after adjusting for fixed effects and time effects. I mean, time effects doesn't matter, but fixed effects do matter. Now, I add on column 5 the unemployment rate. Does the coefficient change? Does the behavior of unemployment help me explain that 2.4 difference? And you can see barely. The coefficient barely moves. So it seems that if you throw cyclical conditions measured by unemployment, you don't get much mileage. What if I do the same thing using my measure of the output gap? So same thing, it almost looks the same, but the coefficients are different. Focus on the small box on the right-hand side. Now I get more of a mileage if I use my output gap measure of a slack. So now I go from a 3% difference. Now the reason why it's 3 and not 2.4 is the sample has changed, because not all countries have GDP measures. So 3% is sort of the starting point. Once I add cyclical conditions, that difference goes down to 2. So if you want, I explain with this regression about 1/3 of the difference of inflation, in this case, relative to advanced economies. Again, I don't think that's a small amount, assuming I'm getting everything right. There's part of the inflation dynamics in Asia that can be explained by these cyclical dynamics. Now, let me try to go from here to policies. Let me start with fiscal policy. First, conventional fiscal policy. Here, I'm just going to do something very quick. I'm not sure how easy it is to translate this into a number. So if I look at the conventional fiscal policy, how much did the structural balances change in Asia compared to other countries? I'm using here Asia excluding China. If I include China, it's very similar. So you see there was a decrease like you expect everywhere else, but it was smaller than in advance, smaller than in Europe, smaller than in Latin America. All of these are EMDs. It was larger than in sub-Saharan Africa, but relative to the other three groups, clearly the fiscal impulse was smaller in Asia, which is sort of consistent with the larger output gap that I've seen before. Now, I'm not sure I can take this number and tell you how much it explains of inflation. In theory, if fiscal policy fits into output, all the effects were already captured in my previous table. So I'm not sure this is adding anything, maybe a story that goes with the previous slide, but I did want to show you these numbers. Now, the other part that I wanted to look at is the unconventional fiscal policy. Again, we said food prices matter, energy prices matter. Food prices matter even more than energy prices in the CPI. We've seen food prices did not increase much in Asia. Could it be that subsidies that played a role everywhere in the world matter more in Asia than in other countries? Now, I'm borrowing this from an IMF database that calculates how much were these subsidies compared to GDP. So I'm focusing on the two boxes in red. So that's Asia. Now, if you compare with the other rows quickly, there are the other emerging market regions and advanced economies on the first line. You can see the numbers are quite big, in particular on the last column. So food subsidies in Asia were a lot bigger than in other countries as a percentage of GDP. Now, I've done my best to look in the literature to see how I translate that into an inflation effect. I have not found a great paper. There's a few of those, and they give you some estimates, but I'm not sure they would apply to this particular event. So I don't have a quantitative assessment that says, and this brought this much of inflation, but at a minimum, it goes in the direction that is consistent with what you see in food price inflation, what is also consistent with the overall inflation. Now, what about monetary policy? Now, here we can do lots of things. I'm just going to give you two messages which go in the direction of explaining some of it. So these are interest rates of a few countries. Now, I'm going to focus on the right-hand side. So that's the real interest rate. So central bank interest rate minus inflation. This is contemporaneous inflation. Now, if you look at India in yellow, Indonesia in blue, hopefully you can see that, South Africa in red. Let me start with those three. Very similar response in real rates. So they move real rates by similar amounts around this episode. Now, what do you see bigger differences? The US took forever to get to the same place, so they move much slower. I don't think that's a surprise to any of you. Advanced economies move slower. Now, Poland moved even slower. I think what happens there, inflation really spiked in Poland, so the real rate looks very low. And then what you see, an interesting contrast, in Latin America, real rates increase significantly more. So in Mexico and Brazil, you see bigger increases. So here is the contrast that I see in particular more interesting to me is Latin America versus Asia. Now here comes a question which is not easy to answer. Do higher real rates mean that inflation should be lower? And it depends how you think about credibility, anchoring of expectations, and how much of a real rate you need to make sure that expectations of inflation stay anchored. Now here I'm going to speculate. Both Brazil and Mexico have a recent history, by recent I mean before 2020, of much higher inflation and much more volatile inflation, that this central bank had to hit the brakes a little bit harder, maybe to get to the same place, or maybe to get to an inflation rate that was slightly higher than in Asia. So that's as much as I can see here. I don't see very large differences between many emerging markets, but I do see that in Latin America, real rates were higher. So if I took that chart as it is, it doesn't say that Asia was tougher than other emerging markets at all. I don't see it just by looking at real rates. Now, how can I see credibility of central banks? How can I think about that matter, the history of inflation? I'm going to do two things. One, look at exchange rates. So exchange rates could react to the possible sort of expected inflation that people saw after 2020. And countries with low credibility are likely to see bigger depreciations of the exchange rate. Now, that's what you see. So the top two lines, the green line and the blue line, are Asia. So whether you do Asia as a whole or Asia without China, exchange rates did not move much. In fact, Asia as a whole, there was a small appreciation. If you look at the other emerging markets, there were significant depreciations. So I read two things here. One, which is important but hard to capture or measure, which is the credibility of different central banks was different and the exchange rate reacted differently. The second thing that I see, if you believe in exchange rate pass-through, here you start seeing another reason why inflation was low in Asia, because the exchange rates did not depreciate. Now, I've done an attempt to put a number to that. So this is the same Phillips curve that I was writing before, focus on the red thing. I throw the nominal effective exchange rate. You get a sign which is consistent with the literature. You get a coefficient which is on the high range of the literature, but is not completely crazy. And if you do a quick back-of-the-envelope calculation, given how much exchange rates depreciated in other emerging markets, you could sort of justify 5 to 6 percentage points during those 2 years in those countries relative to Asia. Again, that is also a significant difference if you were to do a mechanical calculation, maybe a little bit too optimistic, but again, goes in the same direction, and if you take this literally, it also explains a big chunk of the inflation differential. Now, here comes my last regression. This comes partly from a suggestion that Steve made in the pre-conference event that we had. So I was trying to capture somehow how the credibility of the central bank mattered for what we've seen. So what I'm doing here is completely different cross-section. Let's look at the jump in inflation from post-COVID, pre-COVID. And we could take a couple of quarters. I'm taking the whole sample. Can we explain the jump in inflation using just two variables? How high your inflation was before the pandemic, and how volatile the inflation was in the 5 years before the pandemic. We could do 3, 10, I did 5. Now, there's a couple of different samples, all countries, emerging markets, full means all countries that I have data for, small means countries that are consistent with previous samples that I've shown you. So just to see if it matters which sample you use. The coefficients always have the right sign, sometimes become more significant than others. But what you can see here is a very strong result that says high inflation before matters a lot for the change in inflation, not the level of inflation. So the surprise of inflation was much bigger in countries that started with high inflation. And the volatility as well, which is the point that I was making before. And to me, these are two indicators of the credibility of the central banks before this episode. I mean, the R-square is as high as 40% in the last column. That's a big amount relative to the volatility we want to explain. Now, unfortunately, this does not correlate with some of the measures of transparency and independence of central banks that we all use, because that was my goal, to use these measures to see if I can buy some of these results, but I cannot. So here, if you look at measures of transparency and independence of central banks, Asia doesn't look very good compared to other EMD regions. So to me, the level of inflation, the volatility has worked a lot better. So I'm done here. Again, my answer, I think, is straightforward. I'm using the framework that we've used for the US and other countries, and I conclude that Asia had weaker cyclical conditions. And I said I can explain 1 point out of the 3 in those regressions. That is consistent with weaker fiscal policy impulse and the slow reopening. It's consistent with the stronger unconventional fiscal policy, food subsidies in particular. I didn't say this, but it matters. Luck. Rice prices did not go up as other commodity prices, and that matters for Asia. Pork prices started stabilizing or going down in China. That had to do with the swine flu. Again, that was pure luck. And then there's the issue of policy, in particular, I think, the history and credibility of monetary policy and the potential effect through exchange rates, to me, matter more than the response of interest rates, where I don't see a big difference. So it has to be something more fundamental about credibility, anchoring of expectations, and possibly through the exchange rate. Thank you.
Thank you so much, Gian Maria, for giving me the opportunity. And Antonio, thank you very much. I've worked a lot on US inflation, but I am from India and have lived inflation in India, both high and low. So I have to say this, gladly, I have to say this only for 2 months, because actually I'm going back to India. So this is, so let me start by summarizing. I think Antonio did a fantastic job. I think the key stylized fact, which Antonio documents very nicely in his paper through several charts you saw, is basically inflation in Asia was relatively muted, not only relative to advanced economies, we know that, but also relative to other emerging and developing economies. Why is that? Again, Antonio's last slide summarized it quite nicely, but let me give a summary of the summary. I think there are 3 main reasons which Antonio highlights. One is still existing slack in these economies, or weak post-pandemic recovery, which was actually related to high restrictions and stringency during the pandemic. Second is fiscal policy, and interestingly, Antonio highlights 2 aspects of fiscal policy. One is conventional fiscal policy, which is captured through the slack, but then unconventional fiscal policy, which includes price control, subsidies, which we also saw in Europe, by the way. I think there is a... and third is monetary policy. Interestingly, monetary policy was less aggressive in Asian economies, relatively less aggressive, even relative to, say, Latin American economies, which raised rates much earlier and much higher. Yet, inflation expectations were well anchored, and there was limited depreciation of the exchange rate, despite less aggressive monetary policy. So it's not that interest rates increased a lot, and that's why you saw less depreciation, despite interest rates being low, real interest rates being low. Yet you found inflation expectations to be well anchored, and there was limited. So there's a subtle, I think, message in this, I thought, which was quite interesting. So I think, let me first highlight the contribution. I think some of these facts, I have to say, are well known, at least discussed a lot discussed a lot by policymakers, especially Asian policymakers, that look, unlike the US, we did not give big fiscal impulse, and we never had the inflation problem. So, you hear this a lot in the policy commentary. What I found very interesting was that Antonio puts numbers and quantifies these effects, and makes us see some of these effects in the nice pictures which he presents, which I think is the real contribution, to quantify some of the commentary which we are seeing, which we've seen in policy, and to see some numbers attached to those. My first comment is on the link between theory and empirics, and I think here the paper could actually do a bit better. And to be embarrassed, I'm going to highlight some of my work, but I think it's more because I've worked with these frameworks, and so there is the Brookings paper which we presented a couple of years ago, but there's also we are extending the Brookings framework for an NBR conference on inflation in May, where we are looking at a wider sample of countries, which will include Asia as well, and I'll show some teasers from that ongoing work. So here, I think our framework is very simple. We say headline inflation is basically, you can think about it as core inflation and headline inflation shocks. And core inflation is really underlying inflation. So you're trying to, core inflation is basically the textbook inflation, which depends on labor market tightness and inflation expectations. And we measure it by, and we find that measurement of core inflation is quite important. So we measure it by weighted median, which is not only XFE, that is, excluding food and energy, but excluding, any of the volatile industries, which was particularly important during the pandemic, because during the pandemic, if we use XFE inflation, it's very erratic. We cannot correlate it with anything. So I think the measurement is fairly important. And second is these headline inflation shocks. These are high-frequency shocks, relative price changes in particular industries. Not only, food and energy. Again, during COVID, we saw travel, autos, all these. So this is, basically, and the measure of headline inflation shocks is the deviation of headline from core. So this is a simple framework, and I want to read some of the evidence in terms of, the framework. Again, a very simplified framework. So this, Antonio showed the results on headline inflation, but if you think, textbook, really you would relate core inflation. And the results on core inflation are very interesting, because I think I'll just focus, in the interest of time, just focus on column 5. And you can see that in column 5, and whatever measure of unemployment rate we have, once you include slack, the coefficient, I don't know if the pointer is working. Is it working? Oh, no, it's not working. Okay. So the coefficient on Asia is basically statistically indistinguishable from 0, as you see. So then I asked myself, so this means that basically, does it tell me that, if I really go textbook, core inflation, whatever measure you have, it tells me basically it's all about slack. And you showed these nice pictures on output gap and, slack as best as you can measure. But then it's really inconsistent with some of the other stories you're telling about, unconventional fiscal policy, monetary policy. So that's why I thought, looking at headline inflation shocks separately is very important. And again, you showed here how, energy prices and food prices were relatively more muted. But if you think about theory, you have to first of all look at it in relation to the core inflation. So relative prices. So you cannot just look at food and energy, but relative to core, you have to see how these evolved in Asia relative to other emerging economies. So I think, again, thinking through, and not only energy and food prices, but I don't know what other prices, relative price shocks were there in Asia. So thinking a little bit in terms of headline inflation shocks, I think, could add a little bit of more structure to the analysis. This is, again, some work which we are doing, as I said, with co-authors, extending the analysis to a wider set of countries. And let me show you just a teaser slide here. And though it's, this is a wide sample of countries, both advanced and emerging, and you can see this is basically showing you the rise to peak, so basically how inflation rose, but also how inflation fell from peak to the latest. And if you look at, some of the Asian economies here, for example, if you look at Thailand here, Thailand is relatively one of the Asian economies which had a large rise to peak, but also, fell as well. And you can decompose it into core and the headline inflation shock. And you can see that in the case of Thailand, for example, although the headline inflation shocks were the big contributor, but there's a little bit of contribution from core slack as well. Again, if you look at, say, Malaysia is among Asia, it's after Thailand. So the change increase to peak is relatively smaller. But I think the interesting thing is it's also all red. So basically, it's all headline inflation shock. And you can see the asymmetry between the increase and the fall as well. And then if you look at India, India is also very interesting. It's the smallest in the entire pack, but it's half and half divided between the red and the blue. So it's what's happening in India is quite interesting because although the output gap was negative or there was slack, it was moving towards zero.
Move to the mic.
So it was moving towards zero. So basically, you can see that the output gap is closing in that sense. So that's why it's contributing to inflation. So I think one of my broad comments is that unpacking a little bit slack versus headline shocks and highlighting some of the stories of heterogeneity even within Asia might add some flavor to the paper. And as I said, in addition, there's heterogeneity also in the drivers of headline inflation shocks. For example, energy prices and exchange rates were the two top contributors in Malaysia. Energy, food, and shipping costs were the top contributors in Thailand, whereas in India it was more a lot of supplier delivery times, backlogs, etc. So this chart basically is showing the headline inflation shock, and it's showing the dotted line is the predicted based on these three variables, and the black line is the actual. And you can see that these three variables basically explain the evolution of headline inflation shocks almost perfectly in the case of India. And then, I think another thing to highlight, and this I don't know to what extent was it important in the case of Asia, but this crisis was really a lot about non-linearities. And this is for the US, but we have, when we're extending it to other countries, we are seeing similar patterns even for Asia. And the left chart basically shows the non-linearities with respect to slack. And here, of course, with the US, we have better measures, so, V over U. And on the right-hand side, it's nonlinearity with respect to headline inflation shocks. And you can see very nice, feathers and rocket effects for headline inflation shocks. So when headline inflation shocks are low, you have very, the effect on, the effect on inflation is fairly muted, but it increases at a very fast rate if headline inflation shocks are high. And as I said, I don't know to what extent was it true. Although, overall inflation was relatively muted, were there asymmetries and non-linearities in the case of Asia too? I think could be explored in your framework as well. And then, I think, as you know, Ben Bernanke and Olivier Blanchard have this project with a number of central banks. It's mostly advanced economies. But one thing which they highlight, which I find very interesting, that initially the pandemic era inflation was really a result of these relative price shocks. So the relative price shocks, as they increased, you had this initial burst of inflation. And as relative price shocks faded, headline inflation is coming down. However, the labor market is still hot. And the effect of slack is something that might persist. So here again, I think getting some sense of whether how the labor market is evolving and how the slack is changing over time, and how does it continue to be negative or is it closing would be something interesting to note to get a sense of inflation going forward in the case of Asia. So as I said, even in the case of India, even though output gap was negative, it was closing, and that actually contributed to inflation in the case of India. With this, let me conclude. I think it was a really nice paper, very important contribution. The main contribution I see in terms of quantifying some of these effects and some of the narrative we are seeing by, especially by Asian policymakers. I think my main comments would be, threefold. I think putting, linking a little bit more to theory and putting a framework to all the interesting findings you have. Unpacking some of the heterogeneity even across Asia, like I showed you, India, Malaysia, Thailand were quite different. And third is maybe, I don't know if they exist, if there are non-linearities in some of the effects. Thank you very much.
Thank you, Prachi. And would open the floor for discussion, but maybe let me just give a chance to Antonio if he has any quick thoughts, and then we'll open up the floor for discussion. Thank you.
Yeah, thank you very much for your comments. I think you're asking me to do a couple of things that I wanted to do at some point. Some of them, I'm not sure there's enough data to conclude, but maybe I can go into specific examples. I think the core inflation, headline inflation, is an interesting one. I mean, as you've shown, I'm using a measure of core inflation that comes from a database that IHAN and co-authors have produced for emerging markets, and you get some results. Again, I think it's just hard to measure core inflation for these countries. Maybe at some point we can talk about how you're measuring for your project, and maybe there's better ways of doing things. And then the other thing I think that you're saying is true. I think looking at some individual Asian countries and looking at diversity, I think that can be useful. I've done some of that, which is not in the paper, to see whether the aggregate was meaningful, but I think the difference between Thailand, where sort of food subsidies were a lot smaller than Indonesia, for example, I think is interesting, or India, where food subsidies were stronger. Looking at the role of sort of the output gap in different countries, I think that can help me understand some of the data. Again, the nonlinearities is the trickiest one, I think, that I'm not sure how much I can do, but I think the other ones for sure, I think I should do more of that. Thank you.
Thank you, Antonio. So let me open the floor for discussion. Maybe you can just stand your... Perfect. Phil.
Great. Tremendous discussion, tremendous papers, well done. One thing that I've been struck by in the last few years in emerging Asia is, and it's something you actually see across the whole world, is the narrowing or the inversion of the gap between the high-income countries and the low-income countries. So I wondered if you could dig a little more into that issue, because one thing that strikes me as, I won't say puzzling, but kind of very interesting, is that if you take a weighted average of, say, Taiwan, Singapore, well, what I still call the NICS because I'm an old guy, but take the NICS average inflation rate and compare that to the lower income countries, the Malaysias, the Thailands, the Indonesias. That gap used to be significantly higher in the lower income countries pre-pandemic, and then flipped, and has stayed, the differential has stayed flipped. They're both sort of moving down and up together, but there's this sustained gap. And I wondered if you had any sort of explanations as to whether this, or any thoughts as to whether this is a sort of just a matter of luck, matter of cyclical structural developments, or perhaps reflects good policies in some of these lower income countries. So you're sort of seeing superimposed on the pandemic effects, the sort of benefits of a long run effort to go to lower inflation.
Maybe we collect a couple of questions first and then give you the floor back, Antonio. Ayhan?
Thank you, Antonio. It's great. These are just questions, actually. The first one, when I think about Asia versus other regions, especially the regions in this workshop, I wonder to what extent prices, especially certain prices, administered in these countries, in Asia versus Europe. I'm going to make a guess, the extent of administered prices larger in Asia than, for example, emerging Europe. The price of electricity, price of oil, and those make a big difference when it comes to how inflation moves, especially headline. The second thing is, when you are comparing Asia versus other regions, and this is to me a simpler exercise than the exercise we are trying to run here with the frameworks. What is the extent of exchange rate pass-through in this region versus other regions? Because some of these shocks are really common shocks, and how it affects the inflation is going to depend on the pass-through. And the third question is how different inflation targets in this region versus other emerging market regions. I think that's also very useful in terms of thinking about policy response. But great paper.
Steve?
Thank you. That was a very interesting paper. Actually, just following up on Ayhan's first remark, I asked the Asia economist for Citibank the same question: why is Asian inflation so low? And she suggested a couple of other reasons besides the one discussed by Antonio. Well, one of them is, following up on Ayhan's comment, is price controls. Is there much evidence that price controls were more pervasive and more effective in the Asian countries than others? A second consideration, and I'm not sure how much weight to put on this, was that those same supply chain disruptions that led to higher prices in advanced economies had the effect of bottling in goods in Asian economies and thus lowering their price. I was wondering what you thought of that. And then finally, I was very impressed with your result on exchange rates and how those also help to dampen inflation in Asia. And I was wondering how much of that actually might have reflected active exchange market intervention by those economies, as opposed to just the kind of like free market response of exchange rates. Thank you.
Dave?
Just to say I really enjoyed the paper, and being also based out in Singapore, I found that intuitively it matched up to a lot of the sort of more micro analysis that people have done. And I thought that demand conditions being weaker elsewhere in the region, I think about places like Korea and Taiwan, where even the headline growth numbers might be mask actually domestic demand conditions being quite weak this whole time. And aside from their tech exports, you would still have still weak demand conditions. That certainly seems to jibe, and also seems to jibe these unconventional policies. And I guess this is kind of what Steve was also saying, that things like food subsidies really did seem to be larger. And I was just curious, because you had a chart there, which I think was IMF compiled, of 1% of GDP almost, which is quite high compared to others. But I thought it said only a sample of 2, and it would seem to be more pervasive. So I think that point could probably be even stronger made. Thanks.
Francisca?
I like that paper very much. It has all the things I would have expected in there. So I guess most of your arguments are about the size of the shocks. They were just hit by fewer shocks. Luck, because they had rise. Policies, because they had less fiscal monetary stimulus. And I guess the thing you didn't mention, I would add another one that's just sort of a shock. The parts of the region are very close to trade, fairly close. So you wouldn't get these global shocks to them. But the other bit is that perhaps any shock of any given size has less impact on inflation in at least parts of Asia, simply because they have such large informal economies. So that was my one question. Did you look at the impact of these shocks? And perhaps you would see that in your last regression, where you look at the correlation with initial regression, initial conditions, the initial inflation. Did you interact that with the Asia dummy? And then the second comment is perhaps different measures of output gaps would also be useful to use, because I noticed here in 2019 already the output gap in Asia was almost 10% of GDP. That seems a lot. Maybe the trend before the pandemic was just too strong. Thank you.
Let me add a quick question on my end too. First, on the core versus headline, I thought that the subsidies point that Antonio made went in that direction, so that the subsidies can be one reason why the headline shock that he shows was smaller. But I wondered, I think there is already some work on this in the paper, but it will be interesting to see the extent to which you have a smaller shock because of, say, rice versus wheat. Also, gas prices are different in different parts of the world. So I thought it would be interesting to see the extent to which you have a difference in world market price shocks in different regions versus the actual energy and food price shocks in the countries, which will reflect the world price plus the subsidies. Thank you. But I think, great paper, very interesting discussion, and look forward to hearing what Antonio can tell us in a concise way.
I mean, thank you for many of the comments, and these are all things that I think I should explore, in some cases subject to whatever data I can find, as always. But a couple of answers to questions. I mean, the administered price, I struggle with that because I'm not sure how to handle that. I mean, Asia probably has more administered price. That's my guess. I will have to find a good number to back that up. But that was also true in 2009 when inflation was quite high in Asia. So it cannot be that administered price explains always lower inflation. Now, those numbers that I show on unconventional fiscal policy during the pandemic, in theory, they should capture some of that, in theory, because in theory, it's the subsidy to energy and food prices. Again, in practice, I'm not sure, but in theory, maybe they capture that. But it has to be a little bit more than administered prices. Otherwise, in previous years or episodes, you wouldn't see that difference. But again, I'm not sure I have more to say, but I'll try to see if I can quantify that in some way. I did look at the exchange rate pass-through by region, whether it was very different. And in my analysis, it didn't look too different. I know in the literature there's some differences. So I tried that to see, does it matter if I do it by region? But maybe I should look at it again and see if there's anything. Looking at different inflation targets, I think it's interesting. I didn't look at it per se. I look at previous inflation. I should look at that. Phil was asking this question about high-income countries. I was only looking at emerging markets. So I was ignoring Singapore or Hong Kong or Korea. Again, some of those countries they look like the emerging markets. There was not a lot of inflation. Others suffer a little bit more, but I don't have a good answer because I was only looking at the emerging markets. But now, Steve comment about supply chain disruptions. Yeah, I'm not sure how to quantify that. I'm not sure how to make sense out of that unless you really think that the goods stayed stuck in Asia and they needed to be sold there. But I don't know how to possibly. I mean, I think if there's any way to quantify that one. The intervention on exchange rates, I think, is part of what you see there. So it's not just the credibility of the central bank, but again, how do you separate the two? Because if you're committed to a stable exchange rates, I could call that credibility in some way. So again, that's, how do you think about a stable nominal exchange rate? Just pure monetary policy or is manipulation? I think it's a combination of both, depending on who you ask. The question of that these countries are closer to trade. Again, I need to think about how to quantify that in any way. I need to think about the informal economy. I'm not sure how different it is in Asia from some of the other emerging markets I'm looking at. So I think it's going to be a relative comparison to some. And yes, the point you made, Gian Maria, about maybe the shocks to some of these sort of energy and food prices are different because of the particular issues. Again, I know they were in rise for sure in food prices, but maybe there's a way to put a number to that I'll try to do. Yeah, thank you.
Thanks a lot, Antonio. Thanks a lot, Prachi, and thanks to everybody for the contribution to the discussion. Let's move to the second paper, and it's Refet Gürkaynak that is going to present it, and it deals with emerging Europe. And Refet is a professor at Bilkent.
Thank you. It's a pleasure to be here. Thank you for asking me to work on this. Although being from emerging Europe was not something that I ever thought about. So it was a good opportunity. And it was a good opportunity to think about emerging markets in general. The human mind wants categories, and one that is very prevalent in our field is emerging markets. And as we're thinking about what is it? How is it that the emerging markets are different from advanced economies? That's not very obvious, actually, right? I mean, there are two ways of thinking of this. One is the IMF World Bank way of thinking of it, which is just by income levels, right? And that I understand. But in terms of the academic literature, that isn't what we have in mind, right? Implicitly, it's this, we have these models and ways of thinking that are appropriate for advanced economies, but they don't quite apply to emerging markets because they are different, right? Without quite explicitly saying how they are different. Different in a bad way, certainly. That's weird. And I think that was kind of not entirely incorrect in the 1980s, 90s. Right? I used to think then that these are the economies that bizarrely do pro-cyclical fiscal policy. That's what differentiates them. Right? Maybe a better way, I was thinking of this over the weekend, is to say, normal economies, advanced economies have business cycles. Emerging markets have boom-bust cycles. Right? They have crises, and those are fundamentally different things. But by that metrics, since the global financial crisis or so, it's the formerly advanced economies that are very emerging-like, and emerging economies have essentially emerged. So it's really worth thinking about, do we need a separate way of thinking about emerging markets? Do we need to ask separately, if this is what happened in advanced economies in post-COVID inflation, what was going on in emerging markets? Implicitly assuming that it would be something else, right? So most of my talk is going to be saying, at least in the countries that I'm looking at, it really isn't. Okay, so whatever helps you understand advanced Europe inflation in post-COVID period, exactly the same things help you understand emerging Europe, okay? It's just Europe. So it really is important to remember that we need not think of emerging markets as a separate species of countries that require a separate set of tools to understand, okay? The toolkit really works well. And when you apply that toolkit, it turns out that it's the same answer, okay? The European inflation, of course, is kind of different in that I'm going to keep saying energy here, but really that energy, and just because it's easy, I'm going to show oil prices and things of that sort. But really what matters is gas, right? And in particular, dependence on Russian gas. And that was the case for advanced Europe and emerging Europe, and that was it. Now, it's kind of cheap to say that, and it was important that somebody actually looked at this and said, does it really work? And I did. It does really work. Okay. Except one of the glorious emerging European countries is truly different. And in the paper, I spent some time talking about the Turkish case. Recently, I wrote separately on the Turkish case. I'm not going to spend too much time here, but looking at the Turkish case is what really puts that final nail in the coffin and says, okay, there are two broad possibilities here. When you see all these countries simultaneously have this inflation boom. One is they were doing some coordinated stupid policy. Okay, it really was policy coordination on bad policy, or it was an external shock. Okay, the external shock story works well, but if you recall your undergraduate statistics, this really is you're unable to reject the null. The story is consistent with the external shock, but you don't know what it would look like under the bad policy. And then you look at Turkey, you learn what it looks like under bad policy, right? And it's very different. And it's offensive when you laugh. Yeah? Okay, so inflation. You've seen this a zillion times over the past 2 years or so, right, 3 years. It zooms up, comes back down. Now, what is interesting here is the scale. That this is inflation that peaks in 2022 at 3.5%. And when you look at that one, you go, I'm going to say none of you lived in a country that looked like that. Okay? So that was Switzerland. And it's not emerging Europe, but it certainly is Europe. And a fascinating question is, how come the Swiss inflation was so much lower than the euro area inflation? Right? Because Switzerland is this very small island smack in the middle of a sea of the euro area. Right? And one would have thought, I would have thought, they would look very similar. They really don't. Okay? what is the big difference? The big difference is two things, which both boil down to energy. One is Switzerland is much richer than the rest of Europe, the average euro area, which mechanically lowers the weight of energy in the consumption basket. The other one is Swiss energy is publicly produced and price controlled. And therefore, the shock was much smaller, and the weight was much smaller, and there you have it. Okay? So then the question becomes, if that works so well to explain the Swiss case, obviously reductionist, does it work elsewhere in Europe too? So we're going to look at emerging Europe. Okay? Emerging Europe, you don't have Turkey in this table. It has floating exchange rates of sorts. But emerging Europe is a weird hodgepodge of countries, most of which are essentially following the ECB in monetary policy very closely, okay? So here you have Kosovo and Montenegro, which I, to my shame, learned because I was working on this, that have unilaterally euroized, okay? It's not even, fixed exchange rates, whatever. Bulgaria has, to my knowledge, one of the very few successful currency boards, right? That would make Steve Henke proud. And then, but the larger ones, of course, are, Poland, Hungary, and Romania, right? So what I'm going to do is I'm going to define a emerging Europe weighted average. I'm going to exclude Turkey because, A, if I did include it, it would be far and away the largest weight in there. And it was glorious 123% cumulative inflation over those 2 years. We'd just be looking at Turkey, okay? So I'm going to look at the non-Turkey emerging Europe and then talk about Turkey separately. Yep. Very good. Okay. Now, the point here is it's not just that there is this average, but a great majority of those countries are very close to that average. Okay? You actually have two outliers. One is Albania, that has surprisingly low inflation. One is Hungary, that has surprisingly high inflation. But the rest are really close to that average. Okay? So it really isn't that, Poland gets a high weight, so they're looking at, no, they look very much alike. And this is exactly what makes me say something common to these countries must have happened, right? Either they figured a way of screwing policy up simultaneously, or something external to them happened to them. Yeah? It's important to look at core, and core looks kind of similar too. It's not surprising that there is more variance in core, right? But you see more or less the same story in core. Okay. Now, I like doing factor analysis. So if you try to extract factors from these countries' headline and core inflations, it turns out one factor does perfectly well. In headline, that factor is essentially everything, and it loads exactly evenly on all of these countries. That says, the headline inflation was moving in exactly the same ways in these countries, so if you just take an average of them, you're doing perfectly fine, okay? With core, it looks very similar, not exactly the same. Kosovo is somewhat different, and I don't have deep insight into the Kosovan core inflation, but that's the one that's creating the difference there. Nonetheless, you explain, depending on which subsample you choose, something like, 2/3 to 4/5 of the variance in core with one factor that looks like a proper average, okay? Cool, very good. So what we see is inflation picked up in all of these countries at the same time, and inflation peaked in all of these countries at about the same time too, right? So you have to say, if it's policy, it has to be a policy error that is very coordinated, okay? And in some cases, in some places of the world, once you say, it has to be a common policy error across a whole bunch, of 11 countries here, 11 countries coordinating on bad policy, surely it didn't happen. Here, it may have happened, because these are all countries that follow the ECB. So if ECB screwed up, they will all, follow up, okay? But that wasn't the case. Or a common external shock, okay? The common external shock is going to fly. So let's see that. So the first thing we're looking at is oil prices, wheat prices, right? Those are leading. and then the headline and core. This really isn't econometrics, but it kind of works, right? It's weird in that this is levels versus changes, right? It's the level of oil and food prices versus the inflation rate, that's the change. But that's the way it usually works, okay? Now, I'm going to show you a whole bunch of things of this sort. My interest is in trying to understand the intra-emerging European dispersion of inflation and trying to relate that to what was happening to the energy contribution in these countries. So the first thing you look at is the weight of energy in the consumption basket. And then try to relate that to the cumulative inflation, okay, so the sum of the 2 years inflation during the inflation run-up from the beginning of 2021 to the end of 2022, right? That works rather well. And the somewhat surprising thing here is that at the left end, you have Switzerland, where one would say, yeah, okay, as you get richer, the weight of energy in your consumption basket goes down, so that's kind of fine. And then the next one is Albania, which is not known for being a very high-income country. So we'll have to come back to that. But overall, it kind of works, right? But the other, glaring exception there is Hungary, which has much higher inflation than what it should compared to, what its weight of inflation in the consumption basket is, right? Okay. Now, this is more interesting. This was headline inflation. So headline, mechanically, this has to work, okay? This is core. And here, there is no reason why this actually works, okay? Because this is still the weight of energy in the consumption basket versus core inflation, okay? So that's something that gives you a pause for a second and makes you think, what the hell? And there are ways that that relationship might be there. So one is the wage pressure. That is, headline inflation goes up, and then people begin to ask for higher wages, and then that feeds into core, okay? But that's not the only one, okay? Because remember that the weights in the consumption basket are expenditure weights. So countries in which energy is more expensive are going to have, it's not only that incomes is lower or total expenditure is less, but if energy is more expensive, you're going to end up, again, mechanically with a higher weight, okay? And those countries may end up, one can imagine that that has direct production effects too. Okay, so that's something actually testable. And there are two ways you can look at this. One is, if it's the wage pressure, even before energy, you would expect to see this through the food effect, right? My life has gotten more expensive. I'm asking for more wages. That's going to show up through the share of food in the consumption basket before it shows up through the share of energy. And I'm not going to show you that, but that relationship isn't there. In fact, if anything, it's a downward sloping relationship, okay? On the other hand, you can think of the energy shock as a shock to the headline inflation through the weight of energy in the consumption basket, but obviously it's also as a supply shock, okay? And we have metrics to quantify how bad of a supply shock this is for different countries through their energy intensities. So one almost analogous way of looking at this is, did the countries that have more energy intensive production structures suffer worse, okay? So let's look at that. Yeah, so that relationship isn't quite there. And, but it really should be somehow. Energy intensity doesn't work because of exactly what was talked about in the discussion after Antonio's paper, which is energy intensity is not an expenditure share. Energy intensity is not measured as, the value of energy used in production divided by GDP. It's actually a weird measure, which is the physical quantity of energy used, megajoules divided by GDP, okay? But even more importantly, I hate to say this as an economist, but this is a very clear case where cost and opportunity cost aren't the same thing, okay? Countries that import energy, they are beholden to the world energy price. And, you know, they're powerless. Countries that produce their own energy, when the world energy price goes up, keeping energy cheap in the country creates an opportunity cost. And many times, they don't care, okay? So they can actually keep local energy cheap enough if they don't have to import it. So it becomes really obvious that it's not just the energy intensity of production, but how much of that energy has to be imported, okay? So I didn't see in the literature a term for this. I call this energy sensitivity, which is the energy intensity times the share of imported energy, okay? And that relationship really works. So what you have here is Albania is way down there, because I'm going to come back to this. I can say it now. Albania is an energy producer. This I didn't know. Albania has about 0.1% of the world's reserves of oil, some gas too. Okay, that's tiny. Then again, so is Albania. So it works very well. Okay. But the point here is that this distinction between, well, okay, and that was very nicely made in the discussion, right? There is the core and there are the headline shocks. But in this case, a lot of those shocks to the headline were also shocks to the core, right? So it is the shocks that's driving this whole business. All right. And this is it. No, this is not it. Sorry. So this is something similar as a memo item for the euro area. If you look at the energy weight in the consumption basket versus the cumulative inflation rates in the euro area countries, that also works very well, okay? And this is my point, right? You know, nobody is surprised to see this. And you shouldn't be surprised to see the same thing working out in the emerging European countries either, because it's just Europe. These countries are very similar, okay? Up to their monetary policies in most cases, actually. All right. Yeah, so if I try to relate the cumulative energy price increase to the cumulative core inflation, that also works very well. Okay, and you know, here's the decomposition of the core versus non-core, right? Because of the weights, food obviously has a much higher weight than energy, and therefore mechanically explains more. But it's really worth remembering that, you know, except in cases of, you know, drought, crop failure, avian flu, whatever, what we see as food inflation is often driven by energy inflation. There's a nice IMF paper that makes this point, and it was surprising to me that more people hadn't worked on this. But the key here is to see that the commodity price change is at least a half, in many cases at least 2/3 or more of total inflation that we observe in these countries. Okay, cool. So I can turn that into a statistical analysis and run a regression of headline and core inflations on the contributions of energy and food, okay? This is only for 2021 to 2022. It works gloriously well. And, you know, having looked at the relationships that I showed you, you're not going to be surprised that it works gloriously well, okay? But the point here is that the food and energy contributions explain essentially all of the headline, right? And at least half of the core inflation. Okay. So very good. Then again, you know, if you were looking at this and not thinking what kind of a crappy regression is that, you haven't been paying attention, because essentially this is a weighted average regressed on its components. Yeah, better works. Okay. And in the case of core too, right? You know, if inflation is this broad-based increase in prices, you know, I'm going to regress changes in some prices, some average, right, on some individual ones. Maybe it always works, okay? But one of the things, before I come back to this, maybe it always works, is I'm a bit troubled by my ability to explain all of the dispersion in inflation, and in fact all of the inflation itself, in these economies by looking at the commodity price shock, because the literature keeps pushing this supply chain disruptions business. And there is no residual here. Okay, that commodity price shock actually explains it all. This may be a European thing, although the ECB's own analysis for the euro area inflation puts a lot of weight on the supply chain disruptions too. Okay, so that's something worth thinking about by somebody else, I hope. Okay, now, but the econometric issue remains. Maybe this is something that you have to find. Okay, and a cheap test is to do this for some other time. Okay, so this is the same analysis for 2018-19. It doesn't work that way all the time. In fact, this just doesn't work for core at all. Okay, and for the headline, you end up explaining much less of the variance. So it really was a special time in 2021-22 where the commodity price shocks to energy and food properly explains all of the dispersion of variance in emerging Europe. Okay. Very good. So there we have it. This is the story. Now, a minute on Albania and Hungary. Why is Albania, so different? There are two reasons. Reason one is being an energy producer. Okay, well, 2.5. Reason half is Albania subsidizes energy to poorer households, and about all households in Albania are poor. Okay, so that's a very controlled price with an artificially low weight. Okay, but also the Albanian lek was appreciating in this period, and it didn't begin to appreciate post-COVID. It had been appreciating for some time. Again, Albania is tiny, so small external stuff carries over to a large extent. In particular here, they were getting FDI. And that FDI was more than enough to offset their current account deficit, which was appreciating the currency. That appreciation carried at the same rate. There's a chart in the paper if anybody's interested. Okay, so it really isn't this, kind of reverse causality story that what was happening to the lek kept continuing happening in this period too, but an appreciating currency is a very good hedge against the external shock, and that really worked well. This is exactly the same story for Switzerland, right? So Switzerland, there is more causality, but it doesn't correlate with the energy shock. When things get iffy, the Swiss franc appreciates. That strongly happened. In general, the Swiss National Bank fights tooth and nail to stop that. In this case, they were very happy to let the franc appreciate. And then when the franc stopped appreciating, they were like, we'd like to see more of this. So they intervened to make it appreciate. Okay? And in this sense, almost the two ends of the European income distribution, Switzerland and Albania, were very similar in having low weights of energy in their consumption baskets, being independent in energy pricing. Switzerland produces an immense amount of electricity inside the country by themselves, so they can do this, right? And having appreciating currencies. What about Hungary? Hungary, you have to resort to policy, okay? Hungary had an election. They had a very ill-advised, economically well-advised, politically, fiscal expansion. That kind of looked like the US case. Right, on top of an economy that was kind of chugging along, they dumped a huge amount of fiscal expansion, led the forint to depreciate like crazy, and that pass-through, combined with the demand stimulus, led Hungary to have a huge inflation. Hence, macro policy isn't altogether irrelevant. This, hopefully, nobody is surprised about. Right, you do good policy, good things happen. You do bad policy, bad things happen. The point about emerging Europe is these countries have very similar policy mixes because they're following the ECB so closely in general. Hungary was one that didn't have to do this. They had their own currency, floating exchange rates. They could do fiscal policy. They could do monetary policy, right? Chose to do the bad ones, saw bad effects. Okay. Let's look at Turkey. All right. So, yeah, that's different. And the fact that that's different is really important, okay? Turkey doesn't have, following every other country, nothing, and then down. No, right? We had inflation that freaked out the rest of the world now okay? You know, if you remember, Hungarian inflation was much higher than everybody else, and it like really stood out. That's 2018 in Turkey. That's the same order of magnitude, okay? That's the small bump that you're looking at. And if you look at the post-COVID period, there, you know, inflation takes off like crazy, kind of comes back down, and then goes back up again, okay? Those are all very obviously relatable to monetary policy choices. There are a couple of pages in the paper about this. I'm not going to take too much of your time here, but it really is truly deeply fascinating. You know, if you're actually interested in monetary policy analysis, Turkey is painful to live in, but just glorious to analyze. Okay, and I've been doing some of that recently. So let me plug for my own paper. You know, my colleagues and I wrote this paper analyzing the Turkish inflation and the bizarre stuff going on through the lens of a New Keynesian model, and said, you can do this exactly, okay? The New Keynesian model, you know, we think of as well-suited to analyze normal policy. It actually has implications for abnormal policy too, and Turkey shows that those implications are born in the data, okay? It really was the proper way of thinking about this is that the country tried to do neo-Fisherian disinflation even before the term was coined. So we tried to keep interest rates low to lower inflation because the prime minister at the time, the president now, thought that was what the causality is, right? And this goes back to 2010. We can date it. What happens is the central bank begins to build in this inflationary pressure, especially early on. The technocratic expertise in the central bank was very high, and the policymakers were actually good economists, you know, not policymakers with much backbone. So they did actually keep interest rates low, but they did understand what the country needed and what they were doing was wrong. So they found all these ways of trying to offset their own policy through the back door. And that led to a package of truly fascinating policies, like, you know, we're going to keep the interest rate low, but we're going to make the effective rate, the interbank rate, trade in a very wide corridor, and we're going to commit to having the variance be very high in that corridor, okay? So we're going to go for the second moment to offset the first moment. Very long list of really interesting stuff on, you know, things like, okay, so we're going to lower the interest rate and the corridor is going to be narrow too because the government is onto us. But then this was a scarcity-based system. We're not going to lend you. And the banks were like, we're all going to fail. This is a scarcity system, right? And I said, well, you'll have to go to the discount window. So they began to use the discount window as a policy tool, right? All of these things are really interesting in trying to understand how countries may try to substitute essentially fiscal wizardry in the place of decent monetary policy. It doesn't work, okay? And by 2021, after changing 5 central banks governors in 2 years, the president found someone who would just do what he wanted them to do. So, you know, the target was 5%, inflation was 18 at the time. The central bank began to cut interest rates. You ended up with the boom that you saw, okay? Now, that's really fascinating. But these are the kinds of things that constitute a colossal enough policy failure that generates inflation that is multiples of your target, okay? Not the kind of policies that we see in the normal emerging Europe, all right? Very good. So I'm going to end with this that says, look, Switzerland, Euro area, emerging Europe, okay? If you're okay understanding Switzerland versus Euro area, we have no problems understanding what was happening in emerging Europe. One continuing question, and I hadn't thought of this actually, and working on this triggered me. So over the next few years, I think I will work on this. The emerging Europe always has higher inflation than the Euro area. It's not very obvious why. You know, is it just price level convergence? Is it something else? That's an interesting question. But conditional on that, there is nothing interesting in the emerging European inflation. It's just the same as elsewhere in Europe, right? So there you go. You know, you don't need to differentiate emerging Europe from Europe. It's just one Europe, right? Although Turkey is an exception, and that's the exception that proves the rule. it tells you that, if you're creating inflation by bad policy, it doesn't look like what happened in emerging Europe. Inflation shock is the big and clearly identified driver of inflation in these emerging European countries, as it is in Euro area countries. Okay? The levels are different, and that's a good open question that hopefully some other people in this room will pick up on as well. And that's all I have to say. Thank you very much.
Thank you, Refet. And give the floor to Isabel van Steenkiste from the European Central Bank to discuss the paper. Thank you.
So thank you very much for having me here, and thank you for asking me to discuss a paper of Refet. I've never been a discussant of his, but I know him for many, many years, so it was a great pleasure to read the paper and to be asked to formally discuss it as well. The disclaimer applies also in my case. I work for the ECB, but these are my views that I'm going to present here. So I'm just going to spend one slide on summarizing the paper. I'm going to go very quickly over this because Refet was very clear, and the conclusions of the paper are also very clear. So his finding is emerging European countries are not so different, for instance, from Euro area countries. This post-COVID inflation surge, if you look over the 2021-2022 period, was driven by external shocks, and in particular the rise in energy and food prices, although food was to some extent also driven by this rise in energy prices. And these cross-country differences were, that we see within the region, let's say, were driven by the weight of energy in the consumption baskets, and then this combination of the energy intensity of production and the share of imported energy, what he calls in the one denominator the energy sensitivity. And then one last point I wanted to pick up in the kind of main findings is also that the pass-through, it seems at least from the results, to core inflation of these shocks was higher during this period than before the pandemic. Just here a chart, I pinched this from an IMF paper, but I thought it was nice to see how inflation really developed between 2019 and 2022 in Europe. And I think you can see two things there. First is the point that Refet was already making, that before the shock hit, basically, inflation in emerging Europe was to some extent a bit higher than in the rest of Europe, and Turkey was already starting to move off the charts. And then you move to 2022, and you see that really the closer you are to Russia, I mean, the higher your inflation was, right? So, and Turkey nicely is within the group here because we didn't have a separate category, which was deep purple, right, it's off the charts, basically by then. But in the rest of my presentation, I will leave the Turkey question aside because I think Refet knows much, much more about this than I do, and I think it's really like, a case where you say textbook economics actually still works. So in that sense, it's indeed interesting to study, but it's also very sad to see the developments for the country itself. So in my discussion, I mean, what I would say first, I mean, I think, just this conference as a whole and the question that is asked here is actually an interesting one, right? Because a surge in inflation is very bad for the cost of living. It's really, bad for welfare, but once you see variation in the data, you can try to understand what is actually driving the inflation formation process and what are the best policy responses and best frameworks that one has to potentially deal with that. And so in that sense, looking at this episode is very helpful for us to understand better what drives inflation. I mean, the paper is very nice. It has very straightforward results, and I find it very hard to disagree with anything that Refet has written in that. It's simple but clear and clean. So basically, it's really, for those who want to understand what's going on in emerging Europe, really worth to read. I'm going to ask a question, though, is it the full story, right? And an implicit question that is also behind here is a bit like, was there a role for policymakers maybe to lower the impact of the shock? Like, what can policymakers learn from that? Because are they just hit by external shocks and that's it? They should just accept that then inflation goes up and it passes through to core inflation more powerfully. So the first question is there a role for other factors, right? So, I mean, there cannot be a doubt that commodity price shock led to inflation in Europe anyway, right? So I'm just showing here this chart. I mean, we mentioned already a few times before, commodity prices went up strongly, in particular after the breakout of the war. And of course, in Europe, what really stands out is this natural gas price. So these are commodity prices in real terms, right? But I thought it was sometimes better to compare than the nominal terms, where it always all just blows up, even compared to the 70s, right? But you can see where Europe already would stand out. The natural gas price was just, skyrocketing. We've never seen such an increase before. So you would expect that this has an impact on inflation, basically, right? Now the question is a bit, were there other factors in this play? And as Refet already mentioned, in the euro area, we made quite of a story also about supply bottlenecks, pent-up demand coming from the pandemic. I think in the US, there's also the story about interaction of fiscal and monetary policy. I mean, there were other factors that were at play, that were at least seen at play as like in a counterfactual, where you wouldn't have seen this commodity price shock, you would have seen some inflation as well, right? So in this paper, that's not really coming to the fore. And one thing where I thought is also a relevant factor is that if you look at the oil price, for instance, the oil price started to increase already before the war broke out, right? I mean, and that was basically just, the kind of recovery from the pandemic, which also coincided with the supply bottlenecks, pent-up demand. So you may be just wiping up all these factors under this commodity price increase overall. And so in that sense, you may be picking up something, but at least for the 2021 period, you may not be fully picking up that is just this energy price increase, but there were other factors at play, right? So there are some papers that look at that. I think you also quote them in the paper, for instance, from Ben Bernanke and Olivier Blanchard, which try to have a more comprehensive framework to analyze these factors. And I thought maybe that could be one way to see whether really it's only the energy prices, or are there other factors at play. Like, is emerging Europe in that sense different from the euro area? For instance, that it's really only the energy price factors that play a role. A second question I was wondering is why was the impact of the shock larger? And this is a question that you can also ask in the euro area, actually, because if you look there as well, you see the pass-through to core inflation is much stronger than we've seen in the past. So Refet looked 2018, 2019, but if you look for euro area, and I'm sure you'll find the same for emerging Europe, if you even go further back in time, this is like really a much stronger pass-through than we would normally historically have seen. And that also explains, if you look at forecasts, that forecasts on core inflation got it more or less systematically wrong, I think, across institutions, basically, as particular for Europe, right? And so the question is why? I mean, and here I think even for the euro area, the jury is still a bit out there because we have a few theories, but I thought I'd throw them here because I think it's really something for further research, because understanding how inflation moves, in particular when inflation goes up so quickly and so strongly, is helpful. And the first one is a bit of a non-standard one, but I don't know if many of you know the paper by Daniel Kahneman and co-authors on the fairness on price increases, right? I mean, and he gives the example, if you have a snowstorm, right, and people all start buying shovels, you don't see prices increasing for shovels. You see basically that they're just running out of them at some point, because it's seen as highly unfair that people, on top of having to deal with, this snowstorm, they have to pay more for their shovel, right? So companies don't dare to do that. I mean, if you look at in particular, when the war broke out, you can kind of see the opposite effect, right? You can think that actually across the media it was saying the war broke out, energy prices are going up, companies are suffering so much, and it was perceived potentially as fair that companies passed part of this on to consumers, or at least more than they would normally have done. So they accommodate less. So that's one factor, I think, that may be very specific to this episode because it was so widely documented. I mean, it's not easy to analyze, but I think it's really an interesting case study where you could say, does this kind of theory applies? A second one, and this is, I'm going to do like the previous discussion, quote a bit of my own work here, is the question of nonlinearities, right? So we did some work where we looked at the pass-through from wages to headline inflation, basically. And we looked basically at episodes when inflation was lower, in a lower inflation period versus a higher inflation period. And we tend to find in research that the pass-through is much higher when you're basically in this kind of higher inflation environment generally, right? And we have, you can think of a number of explanations for that. In particular, when inflation variability is higher, it's easier for companies to pass through shocks because it's more difficult for consumers to notice that. I mean, I always use the example of Japan, where, you know, maybe a bar of chocolate costs 100 yen for 10 years. If a company increases the price, it's very noticeable. So consumers may switch to basically another produce or another producer, basically. Whereas if there's a lot of variability, it kind of goes under, and so everybody can increase their prices further. I mean, when we did for the euro area this analysis, looking not at just wages, because we had this big shock in input costs, we just replicated our analysis for this shock on input costs. We found indeed that this phenomenon also applies. So this may be a reason why you have a large impact of the shock. In the same paper, we also looked at another factor, which is the type of shock you have. And I think Refet also hinted at that. It was a supply shock. And we tend to find that actually pass-through is higher when you have a supply shock, so that the pass-through from input costs to final prices is basically sharper when you have a supply than an amount shock. So it could be that the same factors are at work for emerging Europe. I wanted to actually, during the weekend, just to run the regressions with the data that Refet has been using for his paper. Unfortunately, my data extraction tool from the ECB was failing, and IT was not available on the weekend. So, but I'm happy to share the code so that you could try that and use that as an extension in the paper. But my suspicion is that the results would look broadly similar. And then a third question that I had was, what explains the cross-country differences? So it's true, first, if you put Turkey in the chart, it looks like there's nobody else. They're all looking very close to each other. If you take Turkey already off the chart, and there is some cross-country variation. And Refet was mentioning already a few factors, but I was thinking it could be helpful, in particular because you didn't really systematically analyze them, right? Like, are there factors important, such as the role of central bank independence? I mean, across these countries in the region, there's quite some difference. Like, does it make a difference, or doesn't it matter so much because most of them anyway tie themselves to the ECB, and this is while they may be perceived as not being fully independent in their laws, it doesn't matter so much. The second question is the type of fiscal support measures. I think the paper on emerging Asia came into that, and I can imagine that in these regions there were also quite a bit of fiscal support measures. So or did countries all end up going for the same kind of measures? And then the final question is something that Refet hinted at towards the end of his presentation: is, does it matter that you had a history of higher versus low inflation? Like, why is inflation in emerging Europe higher? I mean, is there just underlying factors, or is it just like a history dependence that starts mattering there? But I thought it could be interesting to go a bit more systematic in terms of analyzing these cross-country variations, and particularly like the case of Hungary, where, as you mentioned, also the macro policies are not always labeled as the textbook ideals. And then finally, I know this was not a part of the study, but I thought a look ahead, what happened after 2022. I think the decline after inflation peaked is actually as interesting maybe as studying the surge itself, if not even more. But it's still developing, so it's too early maybe still to say. But it can shed a light on some of the other questions, right? So the policy response, for instance, monetary policy. So Refet I was very happy to read that it was not the ECB that was at fault for the inflation. But you can still, given the lags of monetary policy, you would also not expect that after such a shock occurs that you would see whether the policy response is adequate in the first 2 years of the shock, but you would expect to see it a bit further down the line. So was the policy response adequate also on the fiscal side, right? You had often price-based, but also income-based measures. So did that matter, and what does it mean, and basically for the return of inflation? Another question is about labor product market rigidities, right? So of course, there is a very quick up and down, but you can kind of, even in the forecast, you expect that the tail fades out much slower towards in the downward because of rigidity. So can we really see that, and is that very present? And another one, I think, which is important and triggered at least some discussion in Europe as well, is the importance of market power, right? And so I also did some research in that regard that shows that, there is normally inflation variability is actually lower when you have sectors where some companies are more concentrated presence, because normally they price already more to perfection. So, you're already adjusted basically to what the consumer is willing to pay. But especially in the food industry, for instance, there were a lot of discussions in Europe at some point that companies were abusing, let's say, their market power and kept prices high because of that. And I think that kind of developments, given the variability we've seen in inflation and in the data, could also help to understand that, especially also across sectors. So I say in sum an interesting paper, and I think it's really a door opener to conduct further analysis and research, but not just because of this paper. I think this episode just welcomes a lot of questions and can help us to understand better what drives basically inflation, in particular when we see such large shocks. Thank you very much.
Thank you, Isabel. And let me open the floor. Actually, sorry, I should open the floor. Let me give at least a minute to Refet first.
Let me thank you very much. That's a very good discussion. I think all points are well taken. Very quickly, was there a role for policy? I think this is not an easy question to answer for these countries in the sense that so many of them are, have euroized or have currency wars or hard exchange rate fixes, that if the question is monetary policy, they don't have monetary policy. So we're really looking at can we do a broader decomposition? If you want to think of emerging Europe as effectively Poland and Hungary, those things may be done. For most of the other countries, you just don't have the data. Okay, there is no Slack data or supply chain anything for Bosnia and Herzegovina or Montenegro. So it's not easy to do the full decomposition and then say, yes, look, energy prices. That's why I was looking at the energy prices and saying, this seems to explain it all. Having said that, your point about perhaps these energy prices are proxying for other things, that's kind of unlikely because the weight of energy in the consumption basket, that should not be a proxy for a lot of other things other than essentially income. But your last point, I think, is really important. 2 points are really important. One is, why was pass-through higher this time around, right? I think all of your suggested reasons are very reasonable. Another one is, given the war, this was seen as a more persistent energy price increase, and therefore much easier to react to in increasing prices. They didn't have to say, let's wait a little bit and see whether the prices come back down or not. Okay. But your last point of what else explains these differences, central bank independence, fiscal support, history of inflation. History of inflation is a cop-out answer because that then goes back to, well, why was the inflation higher earlier, right? Central bank independence, somebody should work on this, right? Euro area, Montenegro, and Kosovo, these are all euro. They don't have the same inflation rates. They didn't have the same reaction. Why? It cannot be central bank independence. Okay. Fiscal support, I tried to relate things to this, failed because not easy. In particular, I wanted to say, perhaps the countries that had more fiscal space had lower inflation because they could do more subsidies. Okay. But measuring fiscal space is difficult. And you can't just do, let's look at debt to GDP. Right? 40% debt to GDP is nothing for some countries. It's a ceiling for some other countries. A good way of doing this is to look at long-term bond yields, at how the market prices you. Many of these countries don't have trading bonds. So it really is a data limitation that says, great question. I actually don't know empirically how to go about answering this. Thank you.
Thanks, Refet. Let me start with Prachi.
Thank you so much, Refet, and the discussant. I think it was a very, very rich paper, and I think a very rich discussion also. I was really struck by one of the charts which you showed, which was energy prices and core, and then you talked a little bit about, what could be the different mechanisms, and you talked about wages as well. I think this is one of the key things, pass through from headline inflation shocks into core is really one distinctive feature of this crisis. And I thought, maybe I missed it because, I haven't read the paper. If you could tease that out a little bit more in terms of what the mechanism is, and, wages are the standard mechanism, but you could, I think or if you think about an empirical framework where you could test for some of the mechanisms other than wages. You can think about you can think about core inflation on the left-hand side, wages on the right-hand side, and some of other factors, or quantify, what portion of the pass-through was through mechanisms other than wages. And here, I think the non-linearities, which the discussant pointed out, also becomes more, more salient, because demand. For example, if you look at wages, also, if energy prices change or if costs of living change, the demand for higher wages are high. These are more salient for large shocks. So I think, if you could incorporate both mechanisms other than wages, and at least for wages, I think some of the non-linearities, I think that could be interesting. Thank you.
Proceed in this direction. Antonio.
Just a couple of small comments. I think this pass-through is a very interesting question. Why is it stronger this time? Again, I don't know how much of the energy shock was different from previous energy shocks. Does it matter that it's gas versus oil? Does it feed stronger into the cost of companies? I'm not sure what the answer is, but maybe that explains some of what we see there. Now, the other things that, it's true that to some extent all the central banks follow the European Central Bank, and you say there's no monetary policy, but even within the euro area, in particular in the early years, you clearly had very different inflation dynamics. Some of those seem to be correlated with sort of inflation dynamics before the euro was launched. So again, it's not monetary policy, but it has to do with the history of those countries. Again, certainly in the regressions that I've done that include all countries, the level of inflation seems to explain a lot of the change in the inflation afterwards. Now, could it be that there's some of that left, even if there is some shadowing of the European Central Bank? Yeah.
Michael?
Great presentation, Refet. I had a question about the expenditure weights. How long does it take for these energy expenditure weights to get updated? And are they updated on consistent timeframes across the countries in your sample? Because in the US, for example, there's a considerable lag for these expenditure weights to get updated.
Mirko?
Thank you very much. It was a very interesting paper and presentation and discussion. I just had three main questions. The first one also related to the first paper, actually. I've not seen a deeper discussion about inflation expectations in all of this, and I was wondering to what extent these have played a role in explaining some of the variations that we've seen across countries and across regions. The second one is also related to the point that Isabel made, and it's about the timing, because in your presentation you relate, let's say, oil prices or energy prices to changes in inflation. But we've seen a large swings in oil prices also before the war in Ukraine, but also we have not seen these prices coming down in the same way that we've seen inflation coming down, right? So I was wondering whether maybe the time can also help us understand some of these dynamics. And the third point is the links with the ECB policy, and I was wondering whether, these countries, you've thought about whether these countries should have done more active interventions and in this. So if, of course, I understand, they have to follow the ECB policy, you have this currency board and everything, but given that, the shock that they were hit, like it was definitely larger or the inflation rate they were experiencing were much higher compared to the rest of the euro area. Was there room on the side of policymakers to do things somewhat differently and not just to shadow passively the ECB monetary policy? Thank you very much.
Ayhan?
So, great presentation, discussion. So, one thing, maybe this is a question to you, Gianmaria, because the first paper compared emerging Asia with other regions. This paper basically focused on within Europe and then made a comparison. So I thought in the case of Refet, he can run exactly the same principal component exercise, which is easy to do, with other regions' data and look at whether it is the case. Basically, the big story is the oil price or the commodity prices. that will be a kind of comparison across these three regions we are discussing. The second thing, Refet talked about, maybe they were making this big policy mistake. Actually, I was thinking the fact that other than Turkey, most of them follow the ECB. I was wondering whether you see ECB a kind of good anchor for these economies, and actually that led to this outcome in terms of how they responded. And the third issue, when I think about emerging Europe, I think about really the three big countries. Refet mentioned how large Turkey is. The other one is Poland, and the third one is Russia. You did talk about Turkey, and then Poland is in the sample. I can imagine why you excluded Russia, but why did you do it? Why don't you tell us that? So.
Don.
Thank you, Jean Marie, and really interesting presentation and discussion. I wanted to dig in a little bit on the labor market side of that thing. So a really important part of the COVID shock in the U.S. was a sharp drop in labor force participation. And you had very strong demand pushed by monetary and fiscal policy against this reduced labor supply, which has been alleviated over time by immigration and some rebound in labor force participation. But I wondered whether some of these countries had, and maybe there are data limitations here, had different labor market experiences. So going to the point about wages, and so that there would be different pressures across countries on labor costs because they handled the COVID shock somewhat differently one to another, et cetera. So thank you.
So just two quick points. The first relates to a number of the questions from Antonio, from Ayhan, and it has to do with relating the energy price shock, the intensity of the energy price shock to commodity prices. I think in Europe, the effect was larger than what you can derive by just looking purely at gas prices and oil prices. And the reason is electricity pricing. That electricity is priced on the basis in many countries of the highest marginal cost producer. And that is gas. So when gas prices skyrocket, electricity prices skyrocket in countries, even though not all electricity is produced by gas. So you enormously inflate the margins of, wind and solar producers and others. But that has an important inflation component, which you will miss if you just look at overall commodity prices. The second is more of a curiosum on, I think your Refet, your use of Switzerland was fascinating, and it taught me something. I was always wondering why Switzerland sold 150 billion of reserves during 22-23, and now I know from my capital flow work. I always wondered why it went in that direction. Anyway, and fantastic presentation and great discussion. Thank you very much. So I give the floor very concisely, Refet, please, and then we move on to the third paper.
Very good. Thank you for the comments, all well taken. On energy and core, whether we can do more. So my more was looking at the energy sensitivity of the production. So, right, how intensive and how much of that is imported energy, right? So that works. And that's the way to see that, the pass-through is directly to core, not only through wages. Okay? Does gas versus oil matter? It certainly matters, very definitely. Quantifying that is not very easy. Okay? It really requires a very careful study of, where the other end of the gas pipeline is. When is it in Russia versus, Azerbaijan or Iran or Turkmenistan or whatever. Okay. The energy weight, that's a very good point. I worried about that.
it's actually something that changes very slowly. So the energy weight that I show here is the 2019 energy weight, just to be sure that I'm not picking up the mechanical effect of. But if I did it with 2021-22, I would have found more or less the same things. Okay, so that's very good. Inflation expectations. Look, someone with my economic literature persuasion, that's the first thing I wanted to look at. Most of these countries don't have much in that regard. At best, they have year-out inflation expectations, which tend to be everywhere around the world. I mean, advanced emerging markets alike. Year-out inflation expectations almost mirror current inflation. So you learn very little. You want farther out inflation expectations, no such surveys. Then there was the links with the ECB policy. Could they have done more? I don't know. I mean, if you're euroized or if you have fixed, to me, unless you're going to go in your independent way, there isn't much you can do on the monetary policy side. There's certainly scope in the fiscal policy side. And these countries were somewhat differentiated in that regard. But understanding fiscal policy is much more difficult because it's buried in a huge budget, and they are very good at not being forthcoming about what exactly they were doing there. Okay. Is the ECB a good anchor? Well, I'll let Isabel answer that question. Although I thought ECB actually did well, and these countries benefited from having anchored to the ECB. Why no Russia? That's actually a very good question. But I'm just not tooled up enough to distinguish the direct effect of the war on Russia from other things. Someone should do it. That's not my expertise. In particular, the questions of, the abundance, for example, is, we talked about this for Antonio's paper. That's really applicable for Russia, right? These people were exporting energy. They couldn't. They had a insane surplus of energy. What did that do to the Russian prices and Russian production? It's a great question, not one for me, but why don't you take that on? And then on the countries having different labor market conditions, point very well taken, I don't know. I may be able to know this or not. I don't even know whether it's an answerable question. Jamaria's electricity pricing, absolutely, right? Albania is a net electricity exporter, and that's why, right? Switzerland produces electricity through renewables and hydropower. That's why these countries were able to control the price so tightly, and it really made all the difference. Thank you.
Okay, thanks a lot. Let's move directly to the last paper. I'm sorry we don't take a break, but that would mean we have a bit more time to chat over lunch. And it is Juan Pablo Medina who's going to tell us about the Latin American experience. Thank you.
Okay, thank you, Gian Maria, for the invitation and for the opportunity to be here. It's a joint work with Juan Marcos Vlasiuk from the Central Bank of Chile, so the usual disclaimer applies in the case of him. So as we discussed in the first two, so the inflation rise during the last, after COVID was very important concern in many countries. But for Latin America, it's a fundamental test, I will say, because we have a past record of many history of high inflation. So has been a progress, so this was a fundamental moment. And several questions arise. What are the empirical trends in Latin America regarding inflation before and after COVID? How this trend compared with other episodes and with advanced economy? And how do supply shocks or energy price shocks and food price shocks translate to core inflation? And how different is Latin America in this regard? What are the role of monetary policy during this period? So, of course, as Antonio and also Refet mentioned, sometimes due to the data limitation, sometimes the sample for each of these questions are different in the comparison. We don't have the same data for all the signs of the country. So, and as Gian Maria mentioned in the morning, so we, in this presentation and in the draft, we try to summarize results across Latin American countries, in some way taking median, average, and comparing them with the advanced economy. Of course, this approach hides heterogeneity, and this is important to keep in mind. Okay, so I'm gonna try to touch in 4 levels, and this is gonna be a very short preview of results. So we have some idea of the gradual convergence of Latin American inflation in levels, volatility in CPI composition, and similar to what we observed in advanced economy, and that didn't stop during the pandemic. That is important. So it looked like the advanced economy, so earlier, before the pandemic, Latin America was converging from the top to below to advanced economy, and during the pandemic occurred the opposite, was the advanced economy seems converging to Latin America records. The composition of the driving factors, so we try to look for other inflation surge episode. We look 2006, 2008, and was the intensity, of course, was kind of different, but the driving factor was different. So in the earlier episode was more due to excess of demand and relative price shocks. And this episode was more related with what we obtained, more related with the persistence of inflation and the rise of inflation expectation. And that is also important. And then we look for the propagation of supply shocks, and these shocks tend to be more this propagation tend to be more intense in Latin America compared to advanced economy, and that is related with some non-linearity effects. So you're going to see that this is especially true when headline inflation is high or inflation expectation are high. And as many already you know and you notice, the reaction of Latin America policy, monetary policy was different in this episode. And in this episode, you can see that is no particular in this episode is regularly that the monetary policy in Latin America is more influenced by inflation expectation and by U.S. monetary policy. Okay, and these two things rationalize part, not all, of what happened in this recent cycle of monetary policy. So that is the preview, and then so there is a very I try to connect with 3 types of literature. So analyzing the recent episode, there is a lot for advanced economy, the propagation of supply shocks or propagation of any inflationary shocks. There is a lot. And the monetary policy reaction in emerging economies, also there is a lot. I try to connect with these 3 dimensions. So after this introduction, I'm going to try to show some the inflation patterns in Latin America and try to compare with advanced economy. So that is what I said. And then the transmission of supply shocks to core inflation. So, and then monetary policy reaction, and then I'm going to conclude. So we are going to compare inflation rates in Latin America with advanced economy. We use different database. So there is a database by Ian Kose and co-authors with a very comprehensive. We also use a database collected by the colleagues of the central banks. They have less country, but one interesting thing is they harmonized CPI baskets, so they go a very disaggregated level to try to make an harmonization using the Eurostat procedure. And they also interesting, they can separate core inflation in goods and in services. That is something very interesting to look at. And then with that harmonized database, we also try to look for this question of the weights on the CPI component, try to understand, look into the recent episode, and try to look for the inflation expectation and try to make a Phillips curve estimation to try to understand the driving forces of the recent episode compared to another episode. So in the next slide, I'm going to have the inflation rate in advanced blue and Latin America red. These also have the shaded area indicate the 25% percentile and the 75%. So there is heterogeneity, of course. So let's, for example, here you can see the headline. So there was more dissipation in Latin America compared to advanced economy, but you see the convergence. There's less dissipation. But in the recent episode, it seems that for headline, advanced economy compared to the record in that Latin America usually have. Interesting, in the case of energy, you see, probably that is we didn't touch in the detail regarding this, the regulation of energy prices, but you see that in Latin America, you see that it's more stable inflation energy that compared with advanced economy, especially in the recent episode. In food, you see the opposite. You see more variation, but again, in the recent episode, it looks similar. Core inflation, there is a gap, but this gap didn't widen out during the recent past episode, so you see this convergence, okay? And using, this is using the Hutchins Center database, we try to look inside the core inflation, separating service and goods. And we use the database, so the sample is different. So the sample of Latin American country, advanced economy, is different to this, but we try to look inside. And what is increasing is also surprising. Again, the convergence is there as well. When you look core and service, I mean core inflation in goods and in service, you see that there was an increase in some moment of the inflation in goods in the left-hand side, and then a fall in the recent period. This data, the advantage of this that has been updated until February of this year from the Central Bank of Chile. So, and then you see what is the concern that in many advanced economies, that is also a concern in Latin American country, you see the inflation in service is still above what is the typical target, and they look similar, the pattern in the recent period, okay? So try to look with these weights in the harmonized CPIs. You notice this is an average in the recent period of the weight. So FIT is food. It's not exactly the same classification in the other database that you have, because it has food, alcohol, and tobacco as a whole component. Industrial goods that are the core goods, energy separated, and services. And then what you can see here, you have two for each median set of country. You have the own weights and the Eurozone weights. Okay, so what is interesting, at least for us, was to notice that, of course, there is difference with the median Latin American country and advanced economies in this sample. But as you said, food is more important in Latin America than in Europe, but it's not that big difference. You can see that energy doesn't look so different, industrial as well. You notice more different for the rest of emerging economies in this sample that they have. So you notice more different. In the last row, you see that the food is 10% difference in the weight you have the own weights or the Eurozone weights. And then you see the other differences on the other side is in services. Services less important for the own weights in the other. But Latin America doesn't look. So for that reason, we say that there is also a convergence in the composition of the CPI basket in the case of Latin America, and we don't observe that in other emerging market economies. And with this weight, we try to make a zoom in the recent period, okay, for Latin America and for the other set of countries. And this is a chart that tried to decompose this. So the first panel is the inflation increase from the last quarter of 2019 to the peak, okay? And the first bar contained using the own weights, and then the second bar contained what is using the Eurozone weights. So you see that the increase has been smaller when you use the Eurozone weights, but it's still, you don't see much difference. And probably you see that there is food play an important role using their own weights compared to using the Eurozone weights. But there is no big difference in the fall, in the decrease from the peak to the maximum decrease. It's also, you don't see, again, the food and alcohol and tobacco plays a role. You don't see much difference. The other thing interesting that if you take the difference in the February level of annual inflation and compared to what was the level in the last quarter of 2019, the overall, because the number, sorry, I didn't mention that the average Latin American country in this sample is using their own weights is 0.3% above the level of inflation that was previous to the pandemic, okay? And most of that is explained by services. The contribution of energy is low, and the contribution of the other things are very small. And that result remains the same when you use the Eurozone weights, okay? This difference in the graph is because due to the time, I don't have time, but it's done by the advanced economy, also for the rest of emerging economy, and then you see for the emerging economy, these differences are quite more substantial, especially in the reduction phase, okay? But they don't share this last result that overall the inflation is not, in average, is not so different to the level that you observed previous to the COVID, okay? Inflation expectation, that's something, so this is a sample different. We don't have from consensus forecast. The consensus forecast doesn't have the 12-month ahead inflation forecast. What they have in the year of the survey, they asked for the December forecast of inflation of this year and the next year. And with that, we create a series of 12 making an extrapolation. So there is not directly the data, but you can see that, again, what I showed you before, that this convergence of Latin America is still is very evident also in the inflation expectation that advanced economy seems converging from below in the recent period to what is the typical expectation in Latin American countries. Okay, so I try to pick this and try to, as Antonio tried to do, is a Phillips curve. I didn't use output unemployment rate. I use an output gap used with a Hodder-Prescott filter that also have many problems sometimes, but I try to do it just for the sake of comparison and to make the same procedure to compute. And we try to compute this Phillips curve. And what is surprising that there is many control here. There is time effects, there is country fixed effects, and there is a panel different for 5 Latin American countries, like 5 that are Brazil, Colombia, Chile, Mexico, and Peru, and for 17 set of advanced economy. And what is important is when you separate this with this harmonized database core goods, you can see that the role of inflation expectation is important. This variable that we have, particularly for each country, is important to explain and also you see some output gap, not always significant. You see some persistency role of life inflation, especially for core goods for Latin American countries. You see they're different for the core goods and core services in Latin America. You don't see so much difference regarding advanced economy, and what is interesting that the only feedback, because we have the control also, many controls, and also the headline shocks that was mentioned. So we have the food price shocks in this, we have the energy price shocks as well, the past. But it's important that in the relation with the core goods and services, we also put the lag inflation of the opposite component of the core CPI. So for the core goods, we have the lag core inflation in services. And that is the only thing I show you here, what it was significant, that in the case of Latin America, and this occurred not only in the recent episode, it was regularly happening, that each time that the inflation in services increase, there is a tendency to a fall in goods. And there is talk about some relative price adjustment probably that is occurring in Latin America that you don't observe significantly that affects in advanced economy. And with that, we try to make assume with this regression that have some point estimate. So here we have the bar with the composition, and the mention here is with the core inflation in goods. So you see the comparison, the first bar are the episode that I mentioned in 2006, 2009, and then you see that the increase in that episode was 2%, was much, much smaller than what is occurring. And then you see that the driving factor was more like the blue and green relative to the 2%, that are the output gap and other price shocks. In this recent episode for Latin America, you see that you have the persistency, a higher role, and also the inflation expectation. And you see also, again, that the comparison with advanced economy, and again, remember that this estimation is separated, the coefficient are estimated separated for the Latin American country for the advanced economy. So the coefficients are different. But then you see that the composition are not so different with advanced economy. It's smaller the intense, what you have in the last bar, but the composition is quite similar. So the role, probably one difference is the relative price shocks that are the green bar here that are energy, probably in the case of advanced economy. That doesn't play an important role in the case of core goods in Latin America, but also the red bar is this common component. Okay, so still these global factors are important, explained even in the previous episode and this episode, Latin America, the same. You can do the same for the service that I did, and again, some difference emerge regarding what is done in the previous case, but you can see that again, the common factor, the time fixed effects are important, and the inflation expectation are very important in the present episode, also previously, and that's sort of say that, again, there is some difference, at least in Latin America, regarding the other episode that was more driven by price shocks and excess of demand in the previous, and this period was more persistency and inflation expectation. So let me try to go to this transmission or propagation of supply shocks to core inflation. So the idea is pass-through of energy price shocks to core CPI, and try to do this kind of variation. So try to compute additional effects under high past headline inflation. So that idea, we control for past headline inflation, but also we make the interaction. What is the effects of the same price shock, energy price shocks, when the high headline inflation is high? Okay, and for each country, we made this procedure, I don't know, was used for our Gürkaynak regarding try to compute the fiscal multiplier different depending on cycle. Here, instead of being dependent of the growth of the GDP, is based on the headline inflation of each country. Okay, and then we are going to compute these. First, I'm going to do it simple, just. So this regression is a panel, again, separated advanced economy, Latin American economy. We have several control, time fixed effects. And it's important because in a previous estimation that came up in this discussion that if you don't control for time effects in the case of advanced economy, you're going to see that there's a higher increase in the pass-through of energy to core inflation. But when you control for time effects, that take all. That effect. So that's important. When you include the time effects, you get that. So and what you expect, I don't know, for this part it wasn't. So the red line is Latin America, and then you see the pass-through of energy price shock to core after all the control is higher, okay, and clearly higher in the case of Latin America, okay, and you can do it again separating sample. Okay, try to take a sample between 2000 2011, between 2012 and the last data that we have in 2023, and you don't see much the difference. So taking and again, the result survives in the idea that the pass-through is higher in Latin America, and it doesn't look much different now than in the previous sample. Okay. Remember, after that you control for time effects. That is what you get inside each group of country. Okay. If you do it again, separating goods and services, the same result emerges. So this result is robust. So you do it the pass-through in goods and services. Again, Latin America have a higher pass-through than in the case of advanced economy. Okay. So regarding these additional effects, so the idea is you make the interaction. So you make the interaction. What is the additional effects under? So the baseline here is the environment of low inflation for each country. So each country has the variation of inflation. So each country is measured with their own temperature measure of inflation. So it's no absolute levels. It's relative for each country. So an environment of low inflation is the baseline estimation. And on top of that, there is additional effects. Okay, and this is the estimation of the additional effects, and that is related, that explains a little bit that this additional effects is higher in Latin America when the inflation is high, headline inflation, the past headline inflation is high, and this effect is not present in advanced economy. Okay, and then you see, still you see in some horizon, longer horizon, a quarter, you see that when the inflation, headline inflation is high, you tend to see a smaller pass-through, okay, relative to the base in advanced economy, and then you observe the opposite in Latin American countries. For surprise of us, we did the same for the food price shocks, and we didn't find much different regarding Latin America and advanced economy. What we do find that we make also interaction regarding the high headline inflation, and we don't see much different, that is the additional effects, but when the inflation expectations are high, these price shocks propagate more intensively in Latin America, and then you don't observe this phenomenon in the case of advanced economy. So there is something regarding, again, that many people mention, but probably this is not a test, but there is something regarding the credibility of monetary policy in Latin America compared to advanced economy. There is something that, for the reason we try to do, the last exercise is try to rationalize the monetary policy reaction in Latin America compared to advanced economy. And again, due to the data that we collect, we prove many things, and and also following the idea of Antonio and Stephen Camin present, we have this idea, try to understand the changes in the recent episode of monetary policy. So the rise of monetary policy rates in this period, and another period that was the boom of inflation that was, I mentioned, 2006, 2008, and try to compare, again, the average of Brazil, Chile, Colombia, Mexico, and Peru with a set of advanced economy, okay? And this is our estimation. It's not a standard one because I'm using quarterly data. No, it's a cross-section. It's a quarterly data, but I try to explain the change in monetary policy. Usually, estimation is with the level, try to explain. So we put core inflation, output gap, inflation expectation, 1 year ahead, the same data that I show you, and also the change in this variable, okay? Country fixed effects and those elements. And that is the estimation, again, separating the 5 Latin American countries, the 5 advanced countries. And what is very interesting is the sensitivity to the change of inflation expectation in Latin America is quite big compared to advanced economy. Okay, so the changes in monetary policy tend to follow more intensively the change in inflation expectation, and you don't observe that in advanced economy. You see some reaction, some dimension of contracyclicality with this measure of output gap with Jorge Prescott that you see also in Latin America country, and as you see also in advanced economy. But what is striking is this different reaction in terms of inflation expectation. Okay, so I try to look the average change in monetary policy in Latin American country. In the panel A is the period between the third quarter 2006 to the third quarter 2008. And then this is the increases in each quarter of the rate. And then the blue line is the actual average increase, and the red is the prediction of the equation. Okay? In the previous episode of boom inflation, it seems that monetary policy was a little behind the curve in using this equation. In the recent episode, it looks, I don't know, it follows something, but no, probably the intensity or the timing is not exactly the same in the increases phase. But then when you have to ease a little bit the brakes, the prediction is it calls for a more moderate monetary policy, and you don't observe that in the data. And why? Why happened that? And the typical 2 things that all the Latin American concern is, one could be the U.S. monetary policy. What happened with the U.S. monetary policy? And we tried 2 different approaches. So we tried to include also the past changes in the own monetary policy rate, the past changes in the U.S. monetary policy, and also another specification that have the difference between the own monetary policy rate and the U.S. policy. Probably that means you should include the exchange rate. What happens once you include the inflation expectation, the exchange rate never appear in this specification or Taylor rule. Always capture everything, the inflation expectation. We didn't do it. I thought it, but I couldn't do it. Try to make the connection between how sensitive are inflation expectations to the exchange rate, but I didn't do it. I shouldn't do it. And also the comparison, also the comparison with this panel reproduce what I showed you in the previous slide, but also the average change in monetary policy in advanced economy, in the five economies, with the equation that estimate, and then you see that in the early phase of rising was the estimation asked for a higher rate, but then you cannot explain that it has been lower, increasing afterwards, that when there was a slowing down in that part. But I include that, and just with this I'm going to try to end. There is two specifications. One, in all these two new specifications include the past changes in monetary policy on each country, but also the change in the first two columns, the change in the past changes in monetary policy in US. And what is important is, and here I exclude US, so we have 4 countries here, advanced economy that I mentioned, and the 5 Latin American countries. And then what you see here is that role is more intense in Latin America than in other advanced economy. And when you also consider the difference between your own rate with the monetary policy rate in US, that effect also is bigger in the case of Latin America, and that can help to reproduce the idea that in the early episode, the increase in the rate was higher, expecting with the rule, but when you include this, you are getting closer. Not exactly closer, but you are getting in the graph that graph is included, and also in the recent episode, when you expect a lowering or easing the monetary policy rate or the magnitude, you can explain a little bit better that phase, okay? So that is, with that, I'm going to conclude, okay? So there is 4 main messages. So Latin America inflation has experienced a remarkable convergence and stabilization over the last few decades, alignment with the advanced economy in level and volatility. Convergence continue, surprisingly, continue post-COVID, and also convergence to advance in composition of the CPI basket. That you don't observe that in other set of emerging economies. Core inflation rise was clearly more severe than during the other episode. That doesn't occur in many other parts of the world. In the previous episode, the key driver was output gap and price shocks. The key drivers was in the recent episode was persistent inflation expectation. Still in both episodes, the substantial contribution of global factor captured for these time effects. The third message is the transmission of inflation shocks is more intense in Latin America. More propagation is observed when headline inflation or inflation expectation are high. So these are a concern that maybe we are happy that we controlled inflation the previous year, and we are so lucky that we don't have to keep pushing a little bit the role of central bank, independence, and many other things, institutional factor. This is a ring of alert, regarding that we still have potential to enhance more the monetary policy credibility in our countries, okay? And monetary policy in Latin America react more to inflation in contrast to advanced economy, to inflation expectation and to US monetary policy. The first factor helped to explain why central banks raised the rate faster and more aggressively during the 21 and 22. And the second factor contributed to understand the lower normalization of the monetary policy rate since mid-2022. Okay, thank you.
Thank you, Juan Pablo. And our discussant is Ayhan Kose.
Thank you, Gian Maria, for inviting me. It's great to be here. discussing this paper. Gianmaria sent me an email asking me which region I would like to discuss. And I said, I don't have any preference. And he picked Latin America because I am from Latin America. You know, in some circles, Turkey is considered a Latin American country, but I think based on what Juan Pablo said, and based, Refet said, I think Turkey is in a now different group. It's not in Latin America anymore. It's not in emerging Europe. It's somewhere. I don't know where it is. Now, so this paper that Juan Pablo and Juan Marcos wrote, are very comprehensive. I have some Latin American central bankers. I asked them in our group to look at the paper. Guillermo is here. Emiliano, I think, is online. And I also asked my longtime collaborator on these issues, John Graham. He happens to be an ex-central banker as well, so they contributed to my discussion. Now, let me try to summarize the paper as Juan Pablo covered the ground. A lot of things going on in this paper. The idea is to take the Latin American countries and compare with advanced economies over the past 2 decades. If you realize he said something at least 3 times. He said advanced economies converging to Latin American countries in inflation. Don Cohn is here, Steve is here. You see what's going on? The world is upside down. Now advanced economy is converging to Latin American countries. So during this period, this past 2 decades, there is low and stable inflation in Latin America. There's significant commodity price volatility, global financial crisis, and of course the COVID-19. The paper uses multiple methodologies, actually. There's this estimation of Phillips curve. There are some estimations of these local projections models. And then there is this, you know, the kind of the Taylor rule estimations, a set of those. And the other thing the paper does, it uses multiple databases, but multiple samples. That's very more important, actually, the multiple databases. So this is a very ambitious draft. If you want to learn about Latin American inflation and think through these issues, it is, I think, a very clear value added. So I was thinking about what are the main results. I'm going to focus on the 4 of them and simplify them. First, about the convergence of inflation. There's a clear result that inflation, whether you look at the level or the volatility in the region, converge to that in advanced economies. The second, the drivers of inflation. There, the paper looks at this, you know, what happened 21, 22, and there the kind of the story is there is this persistence of inflation, that this lagged effect, and the rise in inflation expectations. That's both related to core, but the different components of core that explains the surge in inflation. So the third result is about response. What the kind of what are the variables driving? There are these inflationary shocks taking place in advanced economies that play a kind of an important role in basically Latin American inflation, and that even kind of the more important when you think about periods of high inflation in the past or high inflation expectations. And finally, the paper also looked at monetary policy, and there the big result is really how important inflation expectations and U.S. interest rates. I think all in all, you know, the rich set of results, clear, as I said, value added to this literature. I'm going to focus on 4 issues here. The first one is this convergence of lag inflation and what basically led to this outcome. I'm going to say that probably that's temporary and driven by some policy changes and good changes in the region. If it is not temporary, it will require actually Latin American central banks do something about it. Second, as much as, we would like to think about inflation, role of the past inflation, the consumption baskets, etc., and the monetary policy, how it responds. We would like to focus on certain models that are going to give us something about the fundamental shocks. In that sense, my discussion is going to be somewhat similar to what Prachi said and Isabel said. We would like to see, a discussion of supply, demand, commodity prices, external shocks, domestic shocks. And then third, and Juan Pablo alluded to this, when I think about inflation and monetary policy response, the currency depreciations or appreciations play a significant role in emerging markets. And this is a kind of a top-of-mind issue in emerging market economies nowadays. And finally, I will make some suggestions about the paper for the next draft. So first, let me talk about the convergence of inflation. So, yes, during this episode and prior to that, there was a convergence. But ultimately, this convergence probably driven by how frameworks in monetary policy making and how much room central banks given in terms of, implement monetary policy over the past, I would say, 3 decades in the region. And our work shows when countries basically adopt inflation targeting, become more independent in terms of their central banks, inflation tends to come down. That's a basically universal result, but they are going to basically take it very seriously. They are not going to be independent or having inflation targets on paper. I think that's what happened in the case of Latin America. That's why inflation expectations become so important to explain monetary policy response. The second issue is that it might be true, actually, Latin American countries' inflation converge to the inflation in advanced economies. But if that's the case, they need to do something about the inflation targets because, in advanced economies, inflation targets are around 2%. When I look at Latin American countries, you see it on the left, targets around 3.5%, 4%, even close to 4.5%. So this observation about convergence has an implication if it is true down the road in terms of what should be the target in the region. Target should be lower if it is truly, similar to advanced economy inflation levels. Now, the second observation, what are the drivers of inflation or the response of monetary policy? Now, the paper has these exercises. One is a Phillips curve exercise, another one is a local projections, another one is a Taylor rule. These exercises look at the drivers of inflation and the drivers of policy interest rates in the region. And they bring a lot of good results, but I was thinking maybe it's better to use a kind of a framework. It could be just a, same framework actually for all these questions Juan Pablo focusing on. That could be a structured VR model with well-defined restrictions that will help, in a sense, to uncover these fundamental shocks in an integrated approach. And then answer questions. How important are the demand and supply shocks? How important are external shocks versus domestic shocks? Commodity prices, global rates, interest rates, terms of trade, exchange rates. And we worked with different versions of these types of models, and they are very, in a sense, flexible. You can have a global block, you can have a domestic block, you can have a multi-country model. Let me give you some examples using the results in this paper. So, for example, there is this result. The recent surge in inflation was driven by inflation expectations, whether it is the core, whether it's the services or the goods. I will ask, that result is a good result, but the question is that what's going on fundamentally? Is it because some supply disruption there, or that leads to, the supply shock, or there is a demand shock because fiscal policy plays a role? Juan Pablo did not discuss, for example, the role of fiscal policy or other interventions during this period, and there were, many of those. There's another result about the role of output gap that contributed less to inflation during this period than 2006-2008 cycle, which is kind of a, the counterintuitive, but the bottom line is that, again, what was the driving force of that output gap that led to basically movement in inflation? And then that, again, pushes you to a corner to think about the demand and supply and, the other factors. The result about monetary policy, again, relates to inflation expectations, which is a great result. It's a success, I think, of monetary policy in the region. But there as well, what is the the underlying source? This might come across as a a non-traditional exercise, decomposing the policy rates, but there is a lot to be learned. We are working on an exercise like this one nowadays. So I think it will be useful to think about a integrated framework to bring together these different questions. The third observation, which Juan Pablo mentioned, the role of currency movements. So in terms of explaining monetary policy, but as well as inflation. The paper talks about, inflation expectations, the commodity prices, the U.S. interest rates. They're all relevant to explain inflation and monetary policy responses. These are in different sections of the paper. But the big issue is that how important is the currency and the movements in currency. In fact, we looked at this issue in the context of what happened in 2022, and there is a big difference in countries. They had, double-digit depreciations in terms of how much inflation increased in that year, versus those they just had a single-digit depreciation. So ultimately, in some cases, this pass-through so large that translated into much higher inflation. In a different exercise, we also looked at, how the policy interest rates in emerging developing economies respond to the depreciations, if these are especially large depreciations. And you see on the right, the monetary policy does respond, and that response actually gets larger over time. So finally, as I said, this is as a draft paper, what can the next draft do? The paper is very rich. In the current draft, there are 11 questions in the introduction. My suggestion is to reduce the number of questions and be very aggressive. When I say reduce, I mean 80%. And the second, I think, a lot of results. Some of these results show you might think that the composition, the inflation basket, how that's composed is important, but then you basically undertake all these exercises, you see that maybe it's not that important. So maybe those results can be in an appendix, but you can focus on the strongest set of results. I really like the results about, for example, inflation, how it relates to inflation expectations, monetary policy, how it relates to inflation expectations, because there's a very nice, consistent narrative that comes out of those sections. And I think I find those parts of the paper very actually strong. And then there's this multiple samples and databases. I think databases fine, but it's very important to keep the sample same from one section to another or within that section, especially the sample comparison. This advanced economy sample also changing, not just the LAC sample. And finally, I think one could look at just 2-3 headline results and undertake quite a bit of robustness around those headline results that will lead to, I think, much richer, in a sense, outcome. So what is the big summary here? If you would like to understand LAC inflation over the past 2.5 decades, Juan Pablo and Juan Marcos put together a very ambitious piece, and really the kind of super rich in terms of the data, in terms of the models, and compared it with advanced economies. A lot of striking results. I think I did not realize how much actually Latin America has made progress when it comes to inflation and how, in a sense, close the gap with advanced economy inflation. In that sense, there is clear value added in this paper. But the bigger point is we need to conduct more research on LAC and emerging market developing economies, inflation and monetary policy. There, I'm going to stop being a discussant and have my hat being a promoter. So we have extensive work program in the World Bank on this issue. There are many reasons for that, but really, ultimately, in emerging developing economies, unless you have price stability and a well-defined monetary policy framework, difficult to see sustained growth. And we have, analysis showing that. So we are working a number of projects with these ex-central bankers in our unit. Some of these results presented in our work. This week on Thursday, we are going to release the new commodity markets outlook, and it's going to talk about recent developments in commodity markets and consequences of those developments for inflation. So let me stop there. Thank you.
Thank you, Ayhan. We are running a bit late, so I'll collect questions. I want to give the floor for a moment to Juan Pablo to respond. Let's try to be concise both on the responses and the questions as well. Thank you.
Okay, thank you, Ayhan. Very nice discussion. Yes, I agree with most of them. Yes, regarding the focus, my fault. I will say that it's my fault. Try to put too many things on the plate. Maybe I don't have a narrative. Regarding the, yes, in the end, I realized that, yes, you make the estimation, but you don't know if this coefficient or this variable is the shocks or there is something behind that is moving that variable. So I have to think a little deeper on that regarding what is driving the result behind this variable that is capturing many other things that are changing over there. So I will say that is my reaction in general, but I will take and comment.
Okay, let me go this time from the other side. Francisca.
Thank you. Very briefly, I like the services and goods distinction because so much of energy and food prices is actually services, non-tradables. So this is nice. One question. In Latin America, in a way, is a bit like Asia, with a lot of heterogeneity across countries. You've got Colombia and Indonesia that are energy exporters and would have benefited. You've got Guatemala, Costa Rica, India, energy importers who would have suffered from the global energy prices. Did you explore that heterogeneity?
Hi, thank you. Very nice presentations. You highlighted the difference in transmission mechanisms from headline shocks to core in Latin America and the role of inflation expectations. Just a couple of questions. One is if you had done the exercise of trying to quantify whether the difference in inflation expectations behavior actually accounts for all of the difference in this transmission between Latin America and advanced economies. And second one, whether you had looked at different horizons of inflation expectations. It seems something remarkable about the recent episode is the stability of medium term, let's say 5 year ahead inflation expectations. Had they moved, maybe the stories around credibility would have been more important. But if you're looking at 1 to 3 years, maybe it's something more about persistence. So I was wondering about that. Thank you.
Okay, thanks, Jorge. Yeah. Oops, I'm missing. Sorry. Go ahead.
Hi. Actually, Jorge took a lot of my questions, but so I think the 1 year ahead inflation expectations is not a measure of central bank credibility issues. It's more picking up the effects of commodity shocks and the effects it's going to have on inflation over the next several months. So inflation expectations, long-term inflation expectations are where you would go. And so I actually for some of the, and so here's where I think a bit more discussion about the heterogeneity across countries would be really helpful. And I thought, like going down the road that Isabel and Refet had suggested would be good. So one thing that was striking for Brazil, I was looking at this, is how low they are, the far forward inflation expectations of 3.5%. And so Brazil embarked around 2017 on a mission of reducing its inflation target to that of its main trading part, well, its neighbors, not Argentina, but to Chile and Mexico. So it's 3% now. And so I think it's remarkable. And so I think, so that's one thing to think about. And also, I mean, I just casually looking at countries like Chile and Colombia, they had major political transitions that produced large exchange rate depreciations, or at least it seems so. And so that seems to be separate from the kinds of shocks that we've been talking about so far. And I think it's something to take into account. Thank you.
So maybe just picking up on a couple of those themes. I mean, I guess I'm totally confused, to be honest. I haven't read the paper, but looking at your presentation, if you'd given me all your analytics, which show a much higher LATAM response to external shocks for inflation, and you'd asked me, and I didn't know the numbers, what had happened to LATAM inflation, I would have said, oh, it's clearly going to be massive compared to the DM world. You know, it turns out complete opposite. You know, your starting point was the correct one, which is that there's actually been an amazing development, which is, you know, America sneezed and LATAM didn't catch an inflation cold for the first time in, 50 years. And I suppose what I'd be looking for, and I apologize, I haven't had a chance to read the paper, is, okay, why is that? What is the, your response functions tell me the opposite. It should have happened. The question is, why didn't it happen? And I think, to be honest, a lot of it comes back to that old chestnut, central bank credibility, and the way that central banks acted. And I think that showed most notably in currency performance. And one of my favorite pop quiz questions is to say, apart from the Swiss franc, which has been the strongest world currency over the last 8 years, and it turns out to be the Mexican peso. Yeah, go figure.
Thank you. My question about the relationship between productivity trends and the story about inflation in Latin America. This may be going a little bit beyond the paper. The region's productivity performance has been very poor. I saw a paper recently which shows that between 1990 and 2017, average TFP growth in the region was minus 0.8% per annum. Now, other things being equal, lower productivity growth can increase cost pressures in an economy. You have lower labor productivity growth translating into stronger increase in unit labor cost. So my question is, how do the authors see this relationship between productivity and inflation dynamics in the region in more recent years? And what does the region's poor productivity performance imply for the trade-off between growth and inflation that the region faces? Thank you.
Steve.
So Phil argued that taking into account Latin America's history of high inflation and the high estimated pass-throughs that Juan Pablo estimated for the